Hello, everyone. Super good to see y'all today. Hope you're having a great Sunday. I want to actually start the stream off by going over a stock that I might consider selling out of, but they had some good earnings, and this is ticker symbol PATH. Let me show you how much of a bag holder I am. And we've sold like a fraction of our position. Excuse me. But look in the very bottom right there. You see how it says 2021? This is when we were buying the stocks. I mean, yeah, what up, Danny? Yes, sir. But yeah, we were buying UiPath in 2021, 9, at $57 a share, 50, and now UiPath is $19 a share. Sorry. A little sick, but we're good. I want to actually go over UiPath's numbers, and then I'll do a stock portfolio update. We're also going to be live later tonight at 8 p.m. Eastern time when the market opens, or the overnight market opens on Robinhood, Webull, and Moomoo. But check this out. UiPath had a massive gap up on their earnings, and the earnings were actually really good. They triple beat. Check this out. The orange line's what the analysts expected. They beat on revenue by a nice chunk. They beat on EPS, which was a slight one-time adjustment, but even so, they beat on the non one-time adjustment numbers and on the EBITDA. So really was a triple beat quarter. The sales, I don't love this company. I don't really know if they have a moat. And what really is a moat? That's like the protection. Like if anyone can copy their business, like GE Aerospace or something, where it's like impossible for them to have competition. But check this out. The revenue grew 15%. And we really don't look at the net income because it says they made $198 million in net income. They didn't actually, but they actually made in real profits $13 million. And the net income was actually around 22. Actually, I think it was like $25 million of net income they actually made. And why is that? Because of their huge net cash position. Check this out. They have actually their cash has been going down because of the share buybacks, but they have $1.4 billion of cash. And that cash isn't just sitting there doing nothing. And we also got to compare the cash to their market cap real quick because the forward PE is really expensive. Oh, come on, please. I guess it doesn't want to load up the income statement. Hold on. There we go. So yeah, they actually make they made 11.7 million of interest just this quarter. They're making 12 million of interest every single quarter on their cash. They have $1.4 billion of cash, and the whole company's worth of 9.9 billion. The forward PE is 104. So that's really expensive, but then you can subtract like 15% for like their cash on hand. I think they're doing share buybacks too. Let me check this out right here. So not in the most recent quarter, but the quarter before they did 100 million of buybacks, 220 million buybacks, 160 million buybacks. That's why their cash position is going down a little bit because of the buybacks. But that's ticker symbol PATH right there. Hey, what up, Tommy? Good to see you. What company do you think has the biggest moat? That's not tech, huh? GE Aerospace I really like that one. Morningstar, that's their whole thing. They rate moats and stuff like that. Hey, try not to spam there. Whoa, dude. Let's check out Nokia here. Yo, Nokia actually just got a big stake from Nvidia. That's the original reason they gapped up, because Nvidia took a $1 billion stake into this company. And they also had some decent earnings. I know they beat on every metric, I'm pretty sure, by a slight bit. Nokia partners with KPN for 800G IP optical network upgrade in the Netherlands. So that's interesting. So let's just go look at their numbers. So yeah, they converted from like selling phones. Like if we scroll out to the monthly here, this is not great. I mean, of course, this is when Nokia was selling smartphones. This is 1997. And actually, Nokia, technically, the stock price is literally the same stock price that it was in 1998. But they're finally like converting from like selling smartphones to like these other business like network infrastructure, mobile networks, cloud and network services, Nokia Technologies. So they have these interesting businesses here. So they beat on revenue. They missed on net income, but they beat on EBITDA. Actually, that was a big beat on EBITDA, 100 or EBIT. That's impressive. So sales were up 17 and the profits were down by 9%. But anyway, they're still making net income every quarter if you kind of average it out here. They're making like 200 mil of net income a quarter, which is interesting. What's the forward PE on that company real quick? Then we'll get on to the next one. Sorry. Actually, wow, a 15 forward PE. Yeah, we'll do LRCX after this. Yes, sir. We'll do CRH. Good morning. Hope y'all having a great day. So here's Nokia. Yeah, 15 forward PE on Nokia. Not too shabby. Yeah, hey, remind me to get to Coremedics as well. I do want to get to Coremedics. So here's Lam Research. They have been booming from their semiconductor technologies and stuff. Let's see here. So they manufacture and service, or they manufacturing and servicing of wafer processing semiconductor manufacturing equipment. And the growth has been very nice. Let's go see if they're beating on expectations. Yeah, that's the orange line. This is why the stock goes up so much on earnings day and they gap up. Every quarter they beat by a big metric on what the analysts expect. They beat on revenue, they beat on EPS, and they beat on EBIT. I mean, it's a triple beat quarter every quarter. The prof. Look at this. That's margin expansion right there. If we go to the sales are up 27, but the net income is up by 40. What does that mean? That means net margins are expanding. Their net margin grew by 10%, which just adds money to the bottom line. What's this website? Yeah, hey, this is actually a brokerage right here. If you want to get it, it's in the link tree in my bio, that very first link there. It's where you buy stocks on. So SoundHound. Oh, actually, let me do that. Actually, wait, we're out of order here. I'm so sorry. We'll get to all the names. Don't worry here. We're going to be live for another 2 hours. Easy. So here's CRH, $80 billion company at a 20 forward PE. At a 20 forward PE, that would tell me like I would not trim or sell out of this company, even though they're pretty much at all-time highs. What did they do? International Solutions, America's Building Solutions, Materials. So it looks like maybe they're at a home builder, or like say building materials, real estate company. Maybe we can check out their website or something real quick. The leading provider of building materials. Pretty cool. Okay. It sounds like a commodity, but the stock is doing fantastic. Let's see how the sales are doing. So the revenue's up 5. So this is like mid to low single digit growth, 2, 3, 5, 5. But the net income's pretty solid. I wonder, it says they lost net income this quarter. I wonder if that was like a one-time adjustment. Did they do like an acquisition? I don't know. Actually, they're spending a lot. Look at their cash from investing activities. They're spending like $1 billion they spent $3 billion this quarter. I wonder what they're buying. That's really interesting. So that'll fund future growth. Anyway, this looks great. That forward PE of 20 is great as well. They made 1.5 bill in net income this quarter after they paid 450 mil of taxes. Let's see if they pay a dividend. Yeah, they do. The cost of the dividend is 250 million, and since the dividend cost is so low, they're doing 200 to 300 mil of buybacks a quarter. Not too shabby. That one looks great there, Tommy. I think they joined the S&P 500. Oh, you're right. I heard you're right, because I remember the ticker CRH. Look at this. So Carvana, Comfort Systems, and CRH joined the S&P 500. And you know what that means for me? My largest holding in here, FIX Comfort Systems, is joining the S&P 500. So I literally can't wait for tomorrow. So actually at 8 p.m. tonight is when the overnight market opens, and we can kind of see how they move. So that'll be fun there. So let me pull up SoundHound AI. Brody, what up, dude? I don't love this one. I've seen their website. Like you give the website a bunch of your voice's data, and then it can create like this AI generated voice that doesn't sound AI generated, but it still does to me. But basically they have this subscription model, and this is the main thing you focus on if you own this stock, is their subscription revenue. And this is the whole reason there's so much momentum around the stock. Check out the growth here. I mean, if they keep this up, this is actually pretty interesting. They used to have, 600, 500K of revenue a quarter from their subscription, but look at these year-over-year growth rates in the middle specifically. Like at this growth rate, what's it going to be the same time next year? So they have, subscription revenue all reoccurring. So that's why I think SoundHound AI is really being watched, beating on expectations on the top line, but they are still losing, their losses are worsening. I don't know how they're losing 50 mil a quarter, but as long as they keep up this top line growth, like this is phenomenal. 67, 200, 150, 190. They're interesting, but I would not have that as like a big size position. My biggest stake, hey, nice. Okay, Cormedic. So this one is, hey, then we'll do Dollar General. Yeah, hey. So here's Cormedics right here. This is another one that you don't want to have as a big size position. There's a huge short thesis on this company. Literally 22% of all the shares are being shorted, but that doesn't scare me. And I'll actually show you this. I do own Cormedics in my Roth IRA. And as much as I love them, they're not a major size position for me. It's a $800 position. I'm down 5% on my shares. I don't really plan to add any more shares. But I love this company. Everything here is headed in the right direction. I'm specifically so bullish on this DefenCath product that they have. It's so growthy. I mean, they literally created this 2024 Q2. The sales were 800K. This quarter specifically, I couldn't believe it. It more than doubled just quarter over quarter to 88 million just this quarter. And remember, I forgot to focus on this. The whole company is worth 830 million. The whole company is worth 830 million. and they're making in net income every quarter. They were making the margin on Deaf and Cath specifically. They literally have a like it's literally a 99% gross margin on their Deaf and Cath prescription, and the net margin is like a 60%. They just included this Melinta product in their portfolio, but anyway, they're making 20 to 50 mil of net income a quarter. And this quarter was a record 51 mil in net income this quarter. So that's what was pretty cool. Yeah, Melinta, they just acquired this company. So remember how the whole company's worth 800 million? Well, they wanted to diversify, so they bought a company for $300 million. They also took a stake into TLPH, which is they have the exclusive right to buy this company if their results are successful. They basically gave them funding. They bought $5 million of their stock at 50 cents a share exactly. And now it's, almost up 3x. Just that has made like $7 million for the stock and unrealized gains. But again, $7 million doesn't sound like a lot, but it does when this is an $800 million company. That's 1% of the company that they just added just for. Anywho, Chrometics is interesting. And I just love the margins, the net income that they make, 50 mil, basically no net debt at all. No debt, but they just acquired Melinta and they took on their debt. They're about to pay this all off because they can so easily afford it. Anyway, I'm just so bullish on their numbers, their prescription of Deaf and Cath, but there is risk. Like most of their sales come from one hospital group. I'm talking about Deaf and Cath, and their patent expires in 2032. Only FDA approved version. Okay, let's see here. What up, Nick? Good to see you, man. I'm a little behind here. Let me get to Dollar General because I know they reported earnings. Same with Dollar Tree. Dollar Tree reported earnings and Dollar General the next day. Wow. So a 19 forward PE on Dollar General. So that's a fair multiple. Let's see. So consumables, seasonal home products. I remember one of the reasons this stock got hit so much is because the government, I can't remember it exactly, but the government didn't allow this isn't it, but it's like they didn't allow the food stamps or something in the Dollar General the same way as before. I don't know, but if we look at their revenue, it hurt their margins. But what's their net margin? So yeah, look at this. They have a 2, sometimes 4% net margin. Like look at their margins back here. They were getting crushed. I mean, but anyway. Let's see what they're doing. They're easily making, and this is after tax net income. Yeah, that really is. They're paying like 120 mil of taxes a quarter. So they're making easily, we'll call it 320 million of after-tax net income a quarter. I know they pay a dividend. The dividend only cost 129 million. So they have like a 30% payout ratio for a 1.8% yield. Not too shabby. Look at that dividend growth. Has been impressive, but the dividend growth has been flat year over year. But Dollar General is interesting. They were back here. They were one of the best performance stocks because they did so many share buybacks. They haven't done any share buybacks in a long time, but they used to be a monster performer. What is this app? Yeah, hey, crazy. If you want to get this app, it's in the link tree in my bio. Very first link there. Broker called Moomoo. It's where you buy stocks. My favorite brokerage. So, all right. Nick said UNH. You know who actually just bought UNH was, not just bought. This was a few months ago. But Warren Buffett, Warren Buffett, the exact day it was disclosed, Warren Buffett bought it, the stock gapped up. And that there was no news. There was no news this day except just Warren Buffett buying. So that's why it gapped up. But the reason the stock is so far off all-time highs is because their margins are never going to be the same. They've not just UNH, but they've all been overbilling the federal government provably, and they're just not going to get the same margin in the future. And look at this revenue right here. So the revenue grew 12% year over year. Great top line growth, 113 billion of sales, revenues up 12, but the profits, the net income fell by 59% year over year. The operating profit fell by 50. So it really did fall 59%. So yeah, their net margin went from a 6.2 to a 2.2. So but the EPS estimates are pretty bullish. I mean, the next quarter is supposed to be real bad. It's supposed to fall to $1.70. Then it's going to go back to $6.15. And if it really does go back to $6.15, that's great news because the dividend costs $2.20. That can pay for 75% of the year's dividend. But I don't love. Let's see, the 2.5. There's so much future uncertainty around UNH, and that's why it's had this bad momentum. What's the forward PE? So they say that forward PE is a 21. The current PE is a 17, but the forward PE is a 21, which means their current net income is supposed to fall, 20, 30% through next year. But at a 21 forward PE, that might be somewhat fair for UNH. I don't know. They're interesting. I wouldn't have it as a big size position. Let's check out this one. I saw someone say, MTZ. This is Mass Tech right here. Yo, Bill stock. I forgot about them. I want to go over Bill after this because I sold them a long time ago. But here's Mastech, a 37 forward PE. The net, wow, the stock's at an all time high, and the net income's supposed to go up another 30% from the previous year. So yeah, they were lost money basically, and now they're going from losing EPS to making 35 cents. So that really is good 30% year over year growth. So they're in clean energy infrastructure, power delivery, communications, pipeline infrastructure. Actually, I really like how diversified that they are. Let's see how that's growing. That's up 19% year over year. Power deliveries up 16. So yeah, it looks like everything here. Communications up 32. Looks like everything here is headed in the right direction. Yeah, wow. Look at these year-over-year net income growth rates. It's like triple digit. So that must mean some nice margin expansion. Yeah. So they're finally profitable. That's great news. Yeah, I can see why this one's done so well. It's like cash flows down a little bit, but that net income growth is real. That's impressive. All right. Nice. So look at Bill right here. I actually used to own this one in this account right here in my Moomoo portfolio, but I ended up selling out of this. And I don't normally do this, but yeah. So I dollar cost average into the stock, and then we ended up selling all our shares on this day right here at $95. We sold all our shares this day, 11 of them. And then we bought one share back, and then we sold that one share back again. I don't know why I traded, but anyway, yeah, dang, there's the forward PE still a loss. So they're not expected to make any net income anytime soon. Yikes. So look at this. That's not great. So the sales growth did kind of slow down. It's just over 10% now, so that's good. Let's hope it stays double digits. But there we see they were narrowing their losses back here, but now the losses are worsening. They're not losing that much. How about the free cash? I know the free cash flow growth is always really impressive over here, but they got a lot of stock-based comp. Well, it's kind of choppy, 0.9, -6. Bill also just partnered with like OpenAI or something. I don't remember, but I don't know. It kind of deserves to be at $50 a share. That's the sad reality. Congrats on Comfort Systems. Yeah, hey, thank you so much, JC. Yeah, FIX just got added into the S&P 500. They only went up 1.7% after hours, but it actually hit a new all-time high after hours. We'll see. The market opens at 8 p.m. tonight. We'll see what happens. By the way, we'll be live around that time. So if you want to hit the follow button, we'll be live around 8 p.m. By the way, if you want to hit the follow button, we stream every day, and I sell nothing. Watch out for people impersonating me. I have no course, book, nothing like that. Sell nothing. So let's check out Celsius. This is an interesting name. What's the forward multiple of 30? That's actually super fair. Check out Monster Beverage, for example. Y'all aren't going to believe how much of a great performer Monster Beverage has been. And they just sell those, Monster Energy cans. Celsius is like their one of their competitors. They own Celsius, Alani, and now Rockstar Beverage because Pepsi decided to buy like 8% of the company, but in exchange, Pepsi gave them Rockstar Beverage and distribution. And so if we go to their net income, it says they lost 61 mil in net income this quarter. They didn't actually. The real business made a record like 166 mil of profit, but they had a one-time charge from a termination fee of their old distributor going over to Pepsi's network. So check this out right here. So they acquired Alani and Rockstar Beverage, but just the Celsius brand, the original organic Celsius brand, just that grew 44%. And Alani grew 114%. So yeah, they have NU Rockstar. And then so profitability declined due to a 250 distributor termination cost linked to transitioning Alani to PepsiCo's network. So pretty cool. Wait, what did that say for the market share? Celsius expanded its energy drink market share to 20%. So look at that. Celsius has a 20.8% market share and grew international revenue by 24%, led by Nordic markets, whatever. So actually, I like Celsius. Actually, also, I own the Coca-Cola bottler right here, COKE. They hit an all-time high on Friday. They bottle for Monster, Coca-Cola, Keurig Dr. Pepper. Hey, try not to spam there. Hold on here. We'll try and get to all the stocks here. Don't worry. All right. Yo, Plasma, what up, dude? What up, Art and Looney? Good to see all y'all. So, okay. Someone just said Pepsi. You know what? Bacardi, let's do Pepsi real quick. They haven't been doing too well because the growth is basically gone on Pepsi, unfortunately. They just can't raise prices too much anymore. But yeah, if we go to the revenue, the lifeblood of the company, the sales, this is like low single digits that doesn't really beat inflation. 2.6% growth, 1% growth, -2, negative. So the growth has been really slow and the margins have slightly come down, like just very like low single digits. But yeah, margins are coming down and sales are coming down. That is why its current valuation of a 27 might be fair. I mean, the forward PE is an 18. That's good, but they have a nice yield. This is one that I think the yield is most likely safe on. You just buy and hold them. They have a 3.8% dividend yield. There's a company I like more. It's called Mondelez. They own so many, like, dang, no way. They hit a 52-week low on Friday. They own Oreo, Chips Ahoy, Toblerone, Chocolate, Cadbury. I mean, they own like the most high quality brands. And this is my favorite pick. Wait, let's see. No, no cookies. Let's see what they own. Yeah, Philadelphia, Toblerone, Milka, Oreo, Belvita. Those are like breakfast bars. So actually, this is one I like. But again, the whole food industry is really struggling right now. One that's not struggling is actual Coca-Cola, the main Coca-Cola company, because they do more syrups and stuff. They don't have like that snack business that Pepsi does. Like I like Frito-Lay. Yo, I have I love all the Frito-Lay stuff. Okay. Ooh, Sean said NU, and I also want to check out Bull stock. Yo, Bull's really interesting. So here's NU. This is a crypto bank out of Brazil, and I love their numbers. Everything impresses me about this company. And if I own this stock, I would absolutely not sell it or trim it at all. I would diamond hand this one because the forward PE is a 20. Now, I believe they don't, or let's see here. So this is the whole reason I love this stock, and this is real. This is their after-tax net income, and I don't know if they pay taxes because they're headquartered in the Cayman Islands. Actually, we can check that real quick. Yeah, they don't pay taxes because the tax rate would be on this list right here. So they don't pay taxes. That makes sense, but they're also applying for their U.S. banking charter. And why? Because right now, 92% of all the revenue comes from Brazil. This is a crypto bank in Brazil, and that's where crypto is actually used for transactional purposes because their currency sucks down there. But check out the net income growth, 41, 30, 47, 50. They are printing net income like an unbelievable amount. So that's what I love about this stock. And the net income is supposed to just continue to climb higher. So I love NU. Like, I love that company. Um, let me do let me get to Kratos, then we'll do Bull after this, and Futu. I just bought more Futu. So here's Kratos, super expensive company. Yeah, the forward PE is at $240, but or they're trading at 240 times next year's net income, like more expensive than Palantir, but they have good numbers. I mean, they have a great government product. Check out what they're reporting versus what the analysts are expecting. This is why this stock has done so well. I mean, the analysts expected like last quarter 305 mil, they did 350. Last quarter they expected 320, they did 350. They're beating on EPS, although the net income is five. Their net income positive every quarter, but the numbers are so tiny. Doing let's say 10 mil in net income a quarter. Market cap is 13 billion. So yeah, that 240 forward PE is still expensive. I'd maybe nibble on this name. I wouldn't buy it meaningfully. But I really do like this one, and all the numbers are like headed in the right directions. But they're also a drone play. They have these unmanned systems. Looks like their drone revenue hit a record 87 million. Yeah, it's never been higher than that before. That's impressive. And they have this government solution software that they were able to raise prices on, which has had nice growth. Anyway, I love Kratos. I'd put them on the watch list. Wouldn't buy them yet, but I love them. Same with Palantir. So here's Bull right here. You know what? The thing is with Bull, they're probably fairly priced at this point. Maybe on the tad bit slight expensive. So that's why I wouldn't own Webull meaningfully yet. but you still want to own this one because I'm just personally so bullish on Webull. I do own them. I currently own 50 shares. We're up 4.8%. And Webull is this brokerage, this app right here, publicly traded. And they've basically copied Robinhood's successful business model. Now on Webull, there's now this Webull premium stuff where you can pay a subscription for $4 a month or $40 a year. Robinhood's is $5 a month or $50 a year. So theirs is like $1 cheaper. And also, what I'm really bullish on specifically is the fact that this brokerage just added in crypto and prediction markets back. So whenever you go do crypto and prediction market stuff, that's where they make a high margin commission. So when you buy and sell a stock, they don't make too much of a commission. So that's what has led Robinhood stock to go up so much. Like their prediction market stuff specifically, I'm extra bullish on. Like they make so much money. So yeah, Webull, if we look at the forward PE, it says a 69. So they are trading at a 69 forward PE, but I'm more they had a big beat on expectations this quarter. Analysts expected 137. They did 157. And it was a triple beat quarter this quarter. And I'm super bullish on them, more than the analysts are. Deleveraging the balance sheet, sales are super growthy, 55%. They made 24 mil in net income, or record net income this quarter. So great. And also, yeah, Futu as well. I really love that one. I own Robinhood, Webull, and Moomoo or Futu stock right here. I just bought 2 more shares of Futu at 169 share. I didn't even mind buying them. They're not expensive. I mean, the forward PE is a 17, and I think it might even be lower. Have you put anything into Netflix, or do you think it'll drop? I have not put anything on Netflix yet, but I'm watching them closely because I would love to buy the dip on them. They're a stock that I would own. But yeah, they're doing an 82 or $72 billion acquisition of Warner Bros. Discovery Studio and HBO Max. So yeah, I guess everything considered, Discovery, HBO Max, and an $82 billion deal. I guess they'll have like the Harry Potter stuff on Netflix and a bunch of other stuff. That would be interesting. Hey, Mr. Phil said, did you see SMX stock? Let's check it out. What up, Mike? We'll check out PARR. I'm a little behind here. My bad. Security matters. Is this the one you're talking about? Yeah, 35. That's a perfect size like position there. Yeah, I'm really bullish on Bull. But yeah, we won't really probably talk about this stock. They're at an all-time low because of all the reverse splits. The stock used to be freaking $1 million. But yeah, the market cap is 300 million. They did go up 130%. I wonder if there's any like specific news here. Maybe I guess those comments. I guess secures 11 million in funding. The whole well, before today, the company was, before this 135% rally, they were worth 110 million. But looks like there's some momentum on this one. That being said, I wouldn't like buy and hold this one for the long run. Yeah, they lose a lot of money. Do they have sales though? They have no revenue. They're a revenue-less company, no sales at all. Yeah, I'd be real careful with that one. But that's a nice little rally it had. PARR. What's this one? What's your biggest holdings? Yeah, hey, my biggest holding was right there. It was Comfort Systems. We'll do a portfolio update in a little bit. We always do a portfolio update at the beginning and end of every stream. If you have any questions for me about my portfolios, let me know. I love being fully transparent. If you want to see my total return or whatever. So here's PARR. They're a $2 billion company, but they're trading at 8 times forward net income, which, wow, look at that monster appreciation. Went from $12 to $43. What does this company do? So refining, retail, logistics. So is this like an oil and gas play maybe? Let's see here. Wow, that actually massive beat on earnings this quarter. Orange lines what the analysts expected there. Beat on revenue, massive beat on EPS and EBITDA. So I thought at first this would be like a one-time adjustment that their net income was so high, but it looks like it wasn't. Like their EBIT earnings before interest and taxes, 3x beat. Yeah, that was real. That's insane. So that's after they netted 260 mil in net income. That's after they paid like 80 mil. What caused that? I mean, maybe they sold off an asset, or I don't know. But that was a great quarter specifically for them. No, they didn't like sell off an asset. Cash flow was that good too. Really interesting there. It's like they did. That's really nice. Good stuff on that one. All right. Where would you buy Netflix? That's a good question. I don't know. Probably 10 to 15% lower. 85 would be a steal. at this perfect 85 level, I feel like that'd be golden on Netflix. But I don't know if it'll get that cheap. I don't know. Maybe if I guess we'll see what happens there. Love to get your view on UiPath. Actually, the whole very beginning of the stream, if you actually want to support me, by the way, I saw nothing. The only thing I have is a YouTube channel. It's called Nathan Roberts, and the link tree in my bio, and you can like rewind the stream. The whole first 5 minutes of the stream, we did a whole deep dive. We spent the whole first like 5 minutes going over UiPath because they reported earnings. We've been diamond handing this one. We were buying this one at like $57 a share, but yeah, they had a nice earnings report. Wouldn't own it with a significant amount of money though. I'm trying to. I've been down so bad on that company, but they have a nice net cash position, earning like 12 mil of interest too. They did beat all expectations. But app using, hey, or this app I'm on right now, this is my favorite brokerage. It's in the link tree in my bio, the very first link there. It's an affiliate link, full disclosure. So if you go and like deposit $100, we'll both get like some free stocks. Yeah, it's my favorite brokerage. It's called Moomoo. Do you like time you're buying or wait for dips? I love the wait for dips, but sometimes if it's a high quality company, I just don't do that. Like I just bought Cavco and HCA Healthcare both on the days they hit all-time highs. I didn't mind doing it just because they're so high quality, and we're just trying to build up my Roth IRA right now. So not always, no, I don't. But if it's a kind of like market right now where I am kind of waiting for a dip to like buy like a Netflix. But if I was like extremely bullish on a company, like I do kind of sometimes wait for a dip. Like I was watching Comfort Systems for a long time, then it had this drop, and then I bought it, and then it dropped more, and then I bought more. So, hey, no way, dude, Puck, dude, with the freaking 25 soccer balls. No way. Thanks, man. If you got a stock you want me to look at, let me know there. I got you. So, all right. Let's see. Thoughts on what up, Isaiah? Thoughts on NVO? So Nova Nordisk, this one's going through a lot of kind of bad news right now. Let's see what's some news down here. Nova Nordisk acquires global rights to Zalantbart and Omeros for rare disease pipeline expansion. Issues first global endorsing GLP-1, including Novo Nordisk. So yeah, actually one thing is Novo Nordisk agreed to cut the prices of Ozempic by 50% in the US. And well, basically, if you go to this is a pure weight loss player. They own Ozempic, Wegovy, Elon Musk is on Ozempic. It's that weight loss thing. If you look at this, 93% of the revenue is their diabetes and obesity care products. And it's $11 billion in revenue a quarter, but the margins have just gone down. So if we go to the sales right here, the revenue is up 11% year over year. So sales are up 11, but the net income's down 22. And it really is down 22 or maybe even slight bit like 25. But yeah, but they still print net income every quarter. But there's a lot of future uncertainty around this name. Like their patent for Ozempic actually expires in like 2 or 3 years, which is unfortunate for them with the increased competition. So that being said, honestly, around a 13 PE might sadly be fair for Novo Nordisk, 13 or something. But you get a nice yield here too. You get a nice 3.8% dividend yield. But I don't know. I mean, they also are expanding, I guess, their rare disease business with the acquisitions they said they're doing. They tried to acquire Metsera, which is a pure weight loss company, but Pfizer ended up acquiring them. Why were they bidding on a weight loss prescription? Because theirs are gonna their patent expires. So yeah, well, that's I guess good. I do own a slight bit of Pfizer. I probably shouldn't for my age, but okay. No way. Hey, shout out to the member Jeff Mack. He said, no, I haven't looked at this stock in so long. This is such an interesting name because this company way back here, and I knew about the bad news before it even came, and I thought it was already priced in. They had this huge they had a huge contract with Microsoft Bing. This is an advertising company, but then Microsoft ended that contract and just does it in-house now. But the best part about this company is their cash on hand. So if we look at the whole company in the top right, the whole company is worth $400 million. So remember that number. The whole company is worth $400 million, and they literally have $315 million of cash and no debt at all. So literally 75% of the market cap is just their cash on hand. And I think they're doing buybacks too. Let me see here. So yeah, look at that, 7 million of buybacks, 33 mil, 6 mil, and 7 mil of buybacks might not seem like a lot, but that's 2% of the company. Just $7 million. They bought back 2% of all. So that's pretty interesting. What website is this? Yeah, hey, if you, this is actually a brokerage right here, and it's not Webull. I do have Webull though, but no, it's in the link tree in my bio. The very first link there, it's a different broker. Um, okay, yeah, very first link in the link tree in my bio, their broker called Moomoo. Okay, so Perry, they we what was the top line growth again? We want to see the growth come back. Like, okay, so the revenue's finally up 8%, but that's, after it fell 44%. I like them for their net cash position. They're earning interest on their cash. They're doing some share buybacks. They also acquired a company called Green Bids. I made some YouTube. I made a lot of YouTube videos about Perry on Network if you want to check it out. Um, but yeah, what up, Jeff? Happy Sunday. Yeah, what up, J Rock and Joe Schmo? What up, dude? Bloom Energy. I think they have some really bullish future expectations here. So their current PE is a 1500, but the forward PE is a 300. So they're supposed to 3x their current net income. So and they're beating on expectations every quarter. So this is probably why it's like appreciated so much. I probably wouldn't buy it here, but check this out. Analysts expected 428. They did 520. They missed on the EPS, but they slight beat on EBITDA. But the EPS growth rates year over year, are really good. If they just meet the expectations, they have been slightly missing on EPS expectations, but top line growth has been there. So yeah, if we go to the net income, it says they lost net income for the past 3 quarters. We probably want to see them get. Actually, these are little one-time adjustments. Actually, they actually went profitable this quarter. No way. So actually, everything here looks like it's heading in the right direction. It probably just looks a little too expensive though. Yeah, what up? Garrett said Kinder Morgan. This is actually a company that owns a bunch of natural gas pipelines. They give you a K1 tax form, I believe. So if this is one of the few stocks, this actually isn't a stock. It's an MLP, a master limited partnership. So you're actually a partner in the company. So you're a unit holder, not a shareholder. So they actually send you a K1 tax form at the end of the year, which is notoriously hard to fill out. But because they are structured like that, you get a 4.2% dividend yield. So yeah, natural gas pipelines, they own 50,000 miles of natural gas pipelines. So it's crazy. And they make good net income easily. It looks like 600 to 750 million of after-tax net income. Yeah, that's after they paid 300 mil of taxes. So they're making 600 mil of net income a quarter. And the dividend cost, actually, the dividend cost this quarter 654 million, and they made 654 million exactly. So you do want to watch the payout ratio, but they're certainly interesting. Probably follow natural gas and oil prices. All right. Yeah, probably $85 for Netflix. That sounds like it. Thunder, if you wait long enough, SoFi will do well for you. Yo, SoFi is a great one. Should we do SoFi? Alphabet doing great this year. Yeah, actually, remind me to get to Alphabet too. I love that company. Most companies, 90% of the companies don't give you a K1 tax form. It's the only stocks that give you a K1 tax form as if they're an MLP, and all the MLPs are those natural gas pipeline companies. If you go to AMLP right here, this is an ETF that owns only MLPs, and like MPLX, Western Midstream. And EPD, Sunco, Energy Transfer is a popular one. So these energy stocks, the ones they send you a K1, but very rarely. Okay. Hey, Buck. Actually, let me get to Circle. You know who actually owns Circle? And we got to get to SoFi and then Google. There's so many great names we got to get to. So let's actually pull up the. I think Kathy Wood bought Circle. Let me check her portfolio. So. Or I guess we can view her whole portfolio here. Oh, you can check all her actual funds here. No way. That's actually kind of cool. ARKQ is like the robotics ETF. Anywho, we'll look at that a little later. But okay, so it's not her top 10 anymore. I remember Circle was around 3 to 4% of her ETF right there. But let's see. Circle Holdings right here. This is your stablecoin play. They own USDC. Pretty cool. Yeah, hey, Zuno, if you want to get this app, it's actually a brokerage. It's in the link tree in my bio, very first link there. But yeah, Circle, they traded an 83 forward PE, but their current PE is 0 because all they've done is lost money. So this is great news. So actually, this is from the IPO fee. So the reason they lost 400 mil, this was a one-time adjustment. They'll never have this again. They actually make net income every quarter. So yeah, but the forward PE of 80 might still be a little expensive. But this is your pure stablecoin play because they literally own USDC, Let's see. So reserve income surged 66%, accounting for 96% of total revenue, supported by a 108% increase in USDC circulation, and their stable coin market share is at 29%. Yeah, hey Puck, if you want to get this platform, it's a brokerage link tree in my bio, very first link there. It's also an affiliate link too. So if you sign up and deposit $100, we'll both get like some free stocks. But yeah. Right here, strategic initiatives included launching the ARC blockchain testnet with over 100 participants, expanding Circle payment network to 29 financial institutions. So right now, stablecoins are really popular because Walmart, I think, is partnering. I think it's with Circle and USDC to make their own stablecoin card. Because if you have a Visa or like a MasterCard, whenever you go spend $100 at Walmart, Visa takes $3 of that, and they don't want to pay that anymore. So the stablecoins being really popular, but Visa's trying to innovate and capture onto that. I don't know. There's a lot of stuff there. So let's do SoFi real quick. SOFI, and then we'll get to Alphabet. Remind me, Lucky, to get to Alphabet. Thank you. So here's SoFi, another expensive name. Like at this current valuation, 46 forward PE is a little expensive. I wouldn't buy it meaningfully here yet. This is a stock I put on the watch list right now. I do own them, full disclosure, so I'm totally biased here. But here's the reason why they deserve a high multiple. Check out this specifically, their financial services business. This growth is monstrous. No analyst expected this. It's up 76% after 101% growth, after 140, after 280, after 290. Like it just hits a new record every year, every quarter. It's 420 mil of revenue this quarter. Annualize that. That's nuts. And that's just one part of their business. They're also in lending. That hit a record for basically 500 mil for the first time ever. That's why I really think people are starting to really take SoFi seriously here. If we go to the net income, they're easily making 100 mil plus in net income a quarter. The sales are super growthy. So I really love SoFi. And if I was a shareholder, I wouldn't be trimming or selling out of SoFi because that was one of my biggest regrets. Same with Robinhood as well. Some of your biggest regrets will actually be selling out of great companies for a profit. So we only have 24 shares of SoFi left and we're up like 4.5x. Same with Robinhood. We used to own like 55 plus more shares of them, but we sold 50 shares. We only have 5 shares left. We sold 50 of them for a 3x gain. It made sense at the time, but now I look stupid because it's up, almost 10x. So all right, SoFi's a great one. No, I'll never be selling the rest of my shares. Let's pull up Google right here. One of my favorite names. It's probably tough to buy it at this current market cap and valuation, but this valuation's really just like bubble valuations, then I don't believe it. Google's at a 30 PE of 30. Amazon's at a forward PE of 30. Meta's at like a 24. Microsoft's at a 28. Nvidia's at a 29. Like valuations are fair, like right now. And that's why I think the market can just continue to climb higher. Santa Claus rally. Again, none of this is financial advice, but here's Google right here. Everything about this company is headed in the right direction. They basically, there was a huge threat. OpenAI, it was another way to search for information on the internet. They used to just be a monopoly for, Google search, but now they won the case where they don't have to sell off Google Chrome because they said OpenAI is a big competitor, but now they've beaten OpenAI at their own game. Google Gemini is better. Gemini 3.0 is better than the best version of ChatGPT. But check this out. This is an ETF in one. That's just one small little bet for them. They literally own YouTube. They own the Android, Google Play Store. They own all of Android. So in the Google Play Store, so if you go spend $100 in the Google Play Store, they collect a $30 royalty on that, 30% networking fee. They have the Google Cloud, which is huge. They just acquired Wiz for $15 billion, puts them in the top 10 cybersecurity companies in the world. Like just the Google Cloud growth has been monstrous. Took a 1% market share away from AWS this quarter. They have Waymo. They're in quantum chips, TPUs. Dude, freaking Meta is considering spending billions on Google's TPUs. So Alphabet launches Gemini 3.0, expands AI TPU production and external sales forecast. What's the forecast there? Analysts estimate TPU could capture 20% of the AI chip market share, representing $900 billion in opportunity. Wow. Here's, I guess, related news. Google's secret weapon, the TPU. So literally the day that like Meta announced the TPUs and stuff, they Nvidia fell 4%, but Google gained 5%. Like it literally took market cap away from Nvidia. It's almost like a hedge in this environment. Like they aren't as susceptible to fall as maybe like an Nvidia, and they can benefit just as much. I don't know. I love Google. I really do, and I'm totally biased, but I'm a shareholder. I'll show you this. They're actually my largest position in this portfolio now. Are they grown to that position? Yeah, we're up 3,000. What's it? We're up 3,000, and the whole position is worth 6,100. So we put like $3,000 in this one, and we're up 97%. Just crazy. Great Mag 7. Here's my total percent change in every stock in here. We're up on every stock in here except Carlisle. Yeah. All right. Um, let's see here. Yeah, hey, I'm hoping Bull and Futu. Those are just great holding for the long run. Yeah. Hey, what up, Thunder? Good to see you, man. So, Nebius, please. So, you know what? Nebius, this is a cloud play. I don't love this part of it. In the long run, there's kind of the bag holders, Well, I don't want to agree with Jim Cramer here, but he had a big short thesis on Nebius specifically. But, like, they're basically, well, they own, there's nothing proprietary. This company just literally owns a bunch of GPUs in a data center. And right now, these GPUs and data centers are in such demand from cloud demand. So Microsoft is actually moving $17 billion of the cloud to Nebius servers because Microsoft doesn't want to take that liability. I can pay the 55, basically 75% NVIDIA tax for their chips and stuff. Like they're spending like tens of billions on chips, and literally in 15 years from now, the value of those chips are literally zero. And there's this whole depreciation thing around Nebius. And I don't know, but I think for the next 2 years, this one will probably do great. But I don't want to, I don't know, hold this one for the long run. But check out its current numbers. You can't argue this because this is nuts. Yeah, hey Donda, this app is in the link tree in my bio. The very first link there. It's actually a brokerage. But check out the growth. The sales went from 32 mil to 150 million this quarter. This was a record 150 million of sales. But check out what analysts are expecting in 2 quarters. 469 million. That's insane. And they are losing 100 million net income plus a quarter, but they're only expected to lose 66 million in 2 quarters. As the sales kind of grow, the losses will narrow, but they're not profitable yet. They're headquartered in the Netherlands as well. So interesting. I maybe have it as a small position, but I'm not touching this one currently. The Nebius, CoreWeave, Iris Energy, APLD, they're all the same kind of thing. They're all getting a bunch of deals from like Microsoft and these um companies needing the cloud demand. Hey, what up, Jeffel? Let's see. Oh, Ubiquity is such a cool company, yo. So, um, hmm. Okay, Ubiquity. This is a phenomenal company. When Apple announced they were getting into doing the same thing Ubiquity does, like Apple hasn't like fully finalized it yet, but Apple wants to get into making tech just like this, like security camera, like a all-in-one home system. But yeah, they make basically like your own servers, and it's a way to like DIY it. So Ubiquity is a great company with phenomenal financials. Check this out right here. So if we go to the revenue's up 33% year over year. So the sales are up 33, but the net income is up by 62. So what does that mean in English? It means the margins are expanding. Check out the margin growth. The net margins went from 23 to 28. And when you're doing, 700 mil of sales, that just adds money to your bottom line. Even that 5% expansion to your net margin. They're deleveraging their balance sheet. No way. Look at this. I remember them always being really leveraged, more liabilities than assets. But look at this. Now that they're printing net income, look at this. The assets are going up, but notice the liabilities are going down. So the liabilities used to be 83% of the assets. Now it's only 44. Massive deleveraging we're seeing here. So Ubiquity is a phenomenal name. I actually... RIP, my sell order here at $117. We'd be up like 5x, but yeah, pretty great company. And what was the forward multiple? Let's see here. Forward PE is a 38. I mean, that's not nuts. That's probably fair. I wouldn't be trimming or selling out of that name. Actually, it gapped down on earnings. This is probably where it needs to be fairly traded. It's probably like reasonably valued right here. It's definitely overvalued, probably like 750 at like a 45 forward PE, but it's pretty good value here. Or okay. What stocks are you buying this week? That's a good question. Probably boring names that it depends on what falls, and I'm not really I don't get paid for a while. So I don't know if I'll buy anything specifically next week, or maybe I'll sometimes here's what you do in your portfolio, and you have to be confident when you do this. Like if you have one position like Pfizer, if you are super confident that you can, like you see another stock dip, you expect maybe 7% of your money back a year on Pfizer. You see a huge opportunity somewhere else where you replace it for a higher quality name or something like that. But yeah, we definitely have some losers in here. Can we check out TE right here? TE. So, are you talking about T1 Energy, Theo? Let me know if you're talking about the T1. You must be. 1.2, oh, small one, $1.2 billion company. But check out Friday. Wow, a 15% gain. That's like a multi-year high on this company. So let's see if there's any specific news here. Um, I don't know if there's any specific news here. There probably is, but it's a small company, so I can't really find it too fast. So they are manufacturing and subsequent sale of photovoltaic solar modules. So maybe they're in the solar industry. Looks like they're losing a lot of money right now. 130 mil, 30 mil, and then 300 mil. But so they basically just went from no sales to a massive amount of sales. Literally, they went from 2 million of revenue to 50 mil to 130 to 210. And there's no year-over-year comps because they just started selling something. So that's kind of the whole good news here. They just started selling their product. Hey, let's actually do, what up, Luca? Let's do PSIX, um, PSIX. So this is one I own as well. We are down a bit on them, but yeah, they had a slight adjustment to their EPS, but it was still a phenomenal quarter. So these year-over-year comps are amazing. 62% revenue growth. Last quarter was 73. So 62% revenue growth. But look at the operating profit. It only grew 38%. So that means their margins, you look at their gross margins, went from 29 to 23. So their gross margins, net margins, I think, but did fall a little bit. But this is still great. They're based off what it was same time last year. And they're also making net income every quarter. We're looking at the operating profit because last quarter says they made 51 million. Well, they only actually made 32 million, which was still a good increase from the previous year, 28%. But I guess it is tough comps. But I don't care because the forward PE is still very fair. The forward PE is a 13. So they're trading at 13 times forward net income. And that was still a huge beat on analyst expectations. Check this out. They beat on revenue, they beat on EPS, and they beat on EBITDA. The EBIT is the real. So is this going to scare me out of selling? Absolutely not. And it's not one I would have as a major size position either. Like I got 5 shares of them. It's worth $300. But I think they're one worth owning like a tiny amount of. And I'm down on them. Okay. MSCI, this is like an ETF. Wait, MSCI. Yeah, this is kind of like an ETF manager. They basically collect royalties. Hey, what up, Crispy? Good to see you, homie. And Ishbar, no way. Good to see you, man. We'll check out Amcor and we'll check out Sprouts Farmers Market. iRobot, no way. I haven't heard that name. I remember Amazon tried to buy iRobot and then the regulators didn't allow it. And then the stock fell like literally 90%. And basically because of that, because the government didn't allow the thing, they went bankrupt. But now it looks like they're having a little momentum. We'll check iRobot out too. What up, Joshua? So here's MSCI. This, what's the forward multiple? So a 30 forward PE, not too shabby on them. So they're an index, analytics, sustainability, and climate. They have like a data network, but yeah, their index just grows nice double digits. Let's see the net income. So they're easily making, that's after tax too. Yeah, that's after they paid 80 mil of taxes. So they're making easily 300 plus million of after tax net income a quarter. Let's see how much the dividend costs. So the dividend only cost 137 million, but look at the cost of the dividend. It went from 1.4 or 140 million to 137. How did the cost of the dividend go down? This is insane. They just spent $1.2 billion buying back their own stock on top of the other quarter. So here's what that does for you. If you look at the net income, it's up by 15.8. The net income's up by 15.8, but the net income per share is up by 19. Again, the EPS growth rate and the net income growth rate should always be the exact same. The only thing that changes it is the share part of the ratio, and the share buybacks make the EPS go higher, which makes the PE ratio go down lower, which makes the cost of the dividend go down and give you more ownership in the company. So it just basically forces the stock to go up. Hey, Granny, thanks so much for the 6 roses there. No way. Do you think Qubits is a buy? Sadly, absolutely not. that one's a pure momentum, extremely overvalued name. But the thing is, you could probably still make a lot of money in QBTS, but this is a swing trade momentum kind of stock. You don't just buy and hold this one for the long run. You kind of just want to swing trade it, in my opinion. Not a good quantum name, but it is a good quantum name in terms of its momentum, and it's like the most popular, but like unfathomably overvalued. Yeah, hey, Lucky, we just looked at Google stock. I think we looked at it the first time you said it, but iRobot right here. Oh wait, we got to look at Amcor. Wait, AMKR. I think they just hit an all-time high pretty much. So yeah, check that out. Specifically, the rally on the past few months here have been insane. Okay, so let's go look at their earnings. So they traded at 34 PE. What's the forward multiple? 26. That's why I wouldn't be trimming out of this company. The forward PE is a 26, and they're beating on EPS every quarter. Yeah, the EPS is going to go from 9 cents to 22 cents. So that's where that forward multiple comes in. So yeah, the business is supposed to just get immensely more profitable. Yeah, it looks like they made 120 million net income this quarter, and the market cap is 10 billion. So 26 forward PE, not too bad. Let's see, advanced products and mainstream products. So, and you get a dividend, a 1% dividend yield there, not too shabby. Maybe we can check out their website real quickly. Advanced packaging test facility. Why? Cool. All right. Yeah, headquartered in Phoenix, Arizona. Okay. Yo, if you got another stock you want me to look at, let me know there. If you, Granny, 08, because Qubits is not a good one, but I'll check out another one though if you got one for me. So iRobot, let's see this one back here. So wait, they jumped on huge news. What was the news? Maybe we can check the weekly brief. Nope, there's not even AI has the news. So, okay, so iRobot valuation after White House Robotics. What? White House Robotics order hype in recent share surge price. I don't know what the actual news is. Maybe someone can find it for me, or it doesn't matter. But that sent the stock up 22%. This is a stock you don't want to own. Let's go look. The whole company's worth $117 million. Yeah, please don't buy this one. Yeah, so the whole company's worth $111 million. Let's say you buy the whole company for $111 million. This is what you're buying. You're buying a business that just lost 21 mil, 22 mil, 80 mil, 70 mil, just for all of eternity. This is why the stock is at an all-time low and crashed after Amazon wasn't able to. They deserve to be at where they're at today. And honestly, this is the kind of stock that's probably just going to continue to go lower and lower to all-time lows. This momentum will most likely just fade off. Wouldn't touch this one. The super leveraged balance sheet. They now have more liabilities than assets. Because whenever you lose net income, that money got to come from somewhere. And literally, just this quarter, they lost 22% of the market cap, another 22%, 80%. That sucks. Not a good name there, unfortunately. But the momentum could be traded or something. Oh, Serve Robotics. I think this one is doing a partnership. Here's another robotics name. I think Serve Robotics has a partnership with DoorDash or something where they've actually done 1 million deliveries of a robot delivering the food to your house. I don't know. I don't remember exactly. Let's see if there's revenue here. There might not be. Yeah, well, see, there's just so much future hopium here. So the sales are 680,000 a quarter. The market cap is, well, I guess, hey, sheep-a-doodle, no way for the 67 roses there, no way. I appreciate that. So the whole company's, we'll check out, oh no, Rich Tech Robotics, that one's not good. But I'll show y'all some better robotics names. But yeah, look at the revenue expectation. It looks like the revenue is supposed to go from 600K to 3.3 million. So I guess that's a nice increase. But yeah, dang, they're losing a lot of money. The whole company's worth 900 mil. They lost 33 mil, 20 mil. So we don't want to see these losses continue to worsen like this. But luckily, they have a great balance sheet. But all this great balance sheet has come from diluting the life out of you. Remember, the whole company's worth 900 mil. Whenever they dilute you by 65 mil, that's 6.5% of the company. 1.3%, 8%. So just in the past year, the total common shares outstanding have literally, you own 40% less of the company than you did a year and a half ago. But them diluting you that much raises them cash and fortifies their balance sheet. So it's just so much future speculation when it's tough to maybe a small fund position. And thanks again for the 67 roses. Yo, sheep diddle. if you got a better stock you want to let me know here, because I feel bad. I'm bagging on everyone's stock here because these are all trash. Like Rich Tech Robotics is not good. I mean, out of all the real, like if you want a real robotics play, if you want exposure to robotics, like this one sucks. No IP, no patents. Check out like Symbiotic or Amazon. Like look at the revenue here. Like the revenue is 1.1 million. It's down 18% year over year. I mean, the revenue used to be much higher in 2023. Like the revenue is $1 million a quarter. They're losing millions in net income every quarter, diluting the life out of you as well, just the same to get up a good balance sheet. But they're doing the right thing there. They're diluting you because they know the stock is extremely overvalued. But I guess the analysts are expecting 1.3 mil of revenue, 2.3 mil. It's just not a great robotics name for the long run. Could be a fun little short-term swing trade, but here's a real one. This is Symbiotic. They have over 1,500 registered IP and patents. This is a warehouse robotics company that actually helps Walmart with their robotics, because that's really the people who are the most to benefit from robotics, like Amazon, Walmart. And Walmart is the second largest shareholder. Walmart owns 13% of all the shares, so they're incentivized to see the company do good. Yeah, this one has over 1,500 registered IP and patents and has real revenue. They're doing 5 to 600 million in revenue a quarter. They're still losing just a slight bit of net income, but at their top line growth rate, that's super okay. But yeah, their website's really cool. Like they really do help out so many, like Walmart and a lot of these warehouses. So yeah, and the videos are so cool. Maybe we could. Hopefully that's not too loud. Actually, I don't even think it'll play the video. But anyway, Symbiotic's cool. Amazon's honestly the best play. Amazon's a huge to benefit as well. But yeah, Amazon, Symbiotic, those are cool. Yo, are you still holding Path? We are. Yo, by the way, best way to support me. I sell nothing, of course. I have no course book. I literally sell nothing at all. The only thing I do have is a YouTube channel. Best way to support me is subscribe to my YouTube channel and watch it from there. Yo, dude, I gotta mute that guy. But try not to spam there in chat. No one else is spamming but that one guy. But yeah, the best way to support me is subscribe to my YouTube channel. It's in the link tree in my bio, or you can just type into YouTube called Nathan Robert. The first 5 minutes of the stream, the whole first 5 minutes, we dedicated to a whole analysis on UiPath. So I'm down bad on my UiPath, but I wouldn't own UiPath as a big size position. They are still expensive. Like they're 42 forward PE. And actually, that's not crazy expensive. And I know that a lot of their market cap is just their cash on hand. So, all right. Datavolt AI. Yeah, don't love that one either. Okay. Hey, Brian Paul, what up, dude? Hope you're having a great day. Yeah, Serve Robotics was interesting. I know, I forget the exact, I couldn't find the news, but I literally think Serve Robotics, it's still one I wouldn't own meaningfully, but they did like over 1 million deliveries with DoorDash, delivering like food to people's houses with like no driver, where the people just have to come to the car and pick it up in the back seat or something. I don't know. Okay. Oh, I just realized my screen froze there. Let me fix that. Yeah, me too. I like you can see the forward PE and the trailing 12 months PE. So you can kind of see what the growth rate is. Like if the trailing 12 months PE is 10% higher than the forward PE. Okay. Can you check out Samsung's DVLT? Let's see DVLT. Let's check out this one. Datavolt AI, $400 million company at all-time lows. The stock used to be $7,000 from all the reverse splits, but let's see. Looks like there's a little momentum right now. So actually, they're basically having revenue for the first time ever. Check this out. These growth rates are good, but it's really small numbers. But the analysts expected 6 million of revenue. They only did 2.9 million, so they did miss on expectations. But if they're right, that'd be like, I don't know, 20 mil of revenue a year. 20 mil of revenue a year. Market cap of 480 million. Net income. Oh, wow. So that sucks. Okay, that actually might make it unviable. So the whole company's worth 480 million. And they lost 32 mil, 40 mil, 10 mil, 10 mil. That's so much of the market cap they've lost in net income. So it's rough. Yeah, that's well over 10% of the market cap they've lost in net income. So we want to see the losses narrow and them have real sales. I don't really know what this company does. Datavolt. Let's see. I'm going to check out their website right here. Let's see what they do. Leverage the power of blockchain. This is a not so great looking website. Well, actually, let's see here. Datavolt platform. Is that the same image twice? Okay. Machine learning, data visualization. I don't know. They got some. I don't know. It's very risky, I'd say. Ooh, Verizon. This is a dividend play. You're buying the stock to maximize your income. Actually, look at this right here. What is this? A rounding bottom. This app is telling me that there's a 95% rise probability. Well, that's the technical analysis, but here's the thing about Verizon. Here's why you buy it just for your income. This stock, Verizon, is the same price that it was back in 1997. So the stock has had no stock price appreciation, but one thing it has had is a massive dividend that is safe and sustainable, a 6.5% dividend yield. So a really nice 6.5% dividend yield, but definitely you're not buying this. You won't outperform, the tech heavy S&P 500 buying this name, but you get the higher income, which is good. If you're 10 years away from retirement, or you would definitely don't want to own that. Hey, what up, Lashon and Coach? Yo, I'm so behind here on stocks. So, and Greed, what up, dude? Oh my goodness. Okay. Uh, what is IBRX? Immunity Bio. Yeah, we won't cover. Well, $2.2 billion company at an all-time low, pretty much. Do they have sales? Actually, they do. It looks like they just got their first ever sales. The revenue went from 6 mil to 40 or to 32 mil. Looks like they have a lot of liabilities there. But oh yeah, so what's the market cap again? 2 bill. 2 bill market cap, and they're losing over 200. Well, actually like 300. So they're losing over 10% of the market cap a year. And they have a lot of debt to pay, and they're diluting the nuts out of you. Ooh, I don't know. As long as they give it this top line growth, like triple digit, even quadruple digit top line growth, comparing from small numbers, but as long as they keep that up, I don't know, super risky there. I just don't love those net income losses there. XTL. Oh, this is an ETF right here. So this is the Spider Telecom ETF. Wow, it's actually done pretty good. Maybe from T-Mobile or something, but let's see what it owns. Well, ticker symbol LIGHT. I've never heard of that company. Lumentum, ASTS Space Mobile. Okay, so Ondas. Ondas, what's their market cap? $3 billion, and it's the 5% of the ETF. CommScope is on there. Cisco, so that's interesting. I wonder if Amphenol's in there too. But yeah, I thought that would have like AT&T and stuff, but no, that's pretty cool. Netflix better than Spotify here, right? I think so, Crispy. Absolutely. No, don't worry, Brian. Don't worry about missing that. Yeah. Yeah, I do like Netflix better than Spotify right now. Have you done Snowflake? We have not done Snowflake yet. There's so many stocks I got to get to here. I'm so sorry. And what up, George? You said Adobe. I want to get to all these. So here's Snowflake right here. This is a data company just like Palantir, where it gives companies and governments actual usage for their data. But one thing I don't love about Snowflake is the net income losses. I just don't love companies that lose hundreds of millions in net income, but it's really not a deal breaker because they are narrowing their losses, but they're losing like 300 to 400 mil in net income a quarter, but they have immense top line growth here. Check this out. If you go to their product revenue right here, this is great. First ever $1 billion quarter. It's up 31%, after grew 29, after grew 38, after grew 83, after grew 100. So the growth they're on a streak of growth. Where's the revenue come from? 76% comes from the US. But Snowflake, actually, they did. This is why it was a good quarter. They beat on revenue and they lost less EPS and net income than expected, and they beat on EBITDA. So that's interesting there. I wonder if there's any news. Snowflake announces $200 million multi-year partnership with Anthropic. Hey, Google owns 15% of Anthropic, and Amazon owns 15% of them. Snowflake reports strong Q3 data, narrows net losses, acquires Crunchy Data to enhance AI. Snowflake doubles AWS marketplace growth. Okay, cool. I love the growth on them, and I love their industry. Which app or site are you on? Yeah, hey, SmartFix. If you want to get this app I'm on, it's actually in the link tree in my bio, the very first link there. It's actually a brokerage where you buy stocks on my favorite app to buy stocks in. And full disclosure, it's an affiliate link. So if you go and deposit $100, we'll both get like some free stocks. A lot of people like the idle cash feature. If you look at them on my screen, you get a 3.6% APY on your idle cash, which is kind of cool. Okay, let's see here. How safe is Robinhood? I also have a Robinhood brokerage. Or actually, all these brokerages, by the way, are all in the link tree in my bio. The one I was just on is my favorite one because it's the most useful. It's free, costs nothing. My favorite one here. But yeah, I love Robinhood as well. Even if like Robinhood or these brokerages go bankrupt, you're still FDIC insured for 250K. And Robinhood and this brokerage I'm on right now is also publicly traded. They print net income. Okay. Um, let's see. Coach Nathan, what up, dude? Yeah, I do like Robinhood. Maybe you're talking about Robinhood stock. I don't know. Maybe you're talking about the stock and not the brokerage. Yeah, hey, if you wanted the like button, follow button, we stream every day. We'll be doing another live stream at 8 p.m. tonight. We're going to be live for another hour. Don't worry. So sorry if I'm behind on some of the stocks. I do want to try and get to all these. So let's do Adobe right here. So Adobe, this is one being hurt by the AI thesis right now. They're saying, in 10 years from now, will we need their products as much like Photoshop, After Effects? I know like you can make a great logo in Google Gemini and ChatGPT, but I'm always a believer that we're always going to need the final touch on art, so that might send us from a AI loser to a slight AI winner, send this up to like close to $400. I don't know. Because the forward PE is a 19 times forward net income. That might honestly be, that might be fair. I don't know. They definitely deserve to fall to like maybe 400 or I don't know. But they're still growing. That bad news of AI hurting them isn't hurting them yet. They're still printing money. We go to the revenue; it's up 10% year over year. The net income was only up 5%, so their net margin did fall a little bit, but still they're making easily 1.8 billion of net income every single quarter. And what are they doing with 1.8 billion net income plus and like 2 billion of free cash flow quarter? Well, they're spending it all on share buybacks right now. You look at the top of my screen here. That's the amount of money they're spending on buybacks, 2 to 3 billion a quarter. What do buybacks do for you? Well, the net income was up by 5.2, but the net income per share was up by 11. So because of the share part of the ratio. So what's the problem with Adobe is their products are overpriced. Yeah, don't tell Adobe, but I have the hacked version. I have the the cracked version of Photoshop. Don't tell them no. But yeah, Adobe, certainly interesting. Wouldn't have it as a big size position though, just because the AI is also hurting Salesforce right now. Like also Figma, a funny story. Adobe tried to acquire Figma, but then the EU regulators didn't allow it. And Adobe had to give Figma $1 billion just for free and a termination fee. And now Figma IPO'd. And they're also at kind of like the bottom, kind of like Adobe. Okay. Ooh, let's Vici, actually IGV software. So let's check out IGV and then we'll look at this is an ETF, pretty cool. And then we'll look at Vici. So IGV, this is actually an ETF, which is just a basket of stocks. And this is in the tech software sector. So let's go see what they own in the ETF. Wow, Palantir is the largest holding. So that's 9% of the ETF. Microsoft is 8.5. Salesforce is 7.5. Intuit. These are great software names. Yeah, CrowdStrike, Palo Alto. It has all the bit of software. One of my favorite parts of software is like cybersecurity right now. It's like immune from all the AI stuff, but what's the difference between SPY G and SPY M? SPY G, I don't know. That's you can just look at the names and probably find out. Probably just look at the difference in the holdings. Yeah, hey Sam. Yeah, this is a brokerage. It's in the if you want to get this brokerage I'm on, it's in the link tree in my bio, the very first link there. Let's see, SPYM. SPYM. So this is just like the S&P 5. Oh, this is okay. So SPYM. This is the SPY with the lower expense ratio, only a 0.02% expense ratio. This is kind of like the QQQM. Yo, so SPYM is probably pretty much my favorite way to get exposure to the S&P 500, lowest expense ratio way. Hey, Isaiah, what up, dude? Hope you're having a great day. Let's see. Let me get to Vici. And then we'll get to Okta. Okta's a cool one, but still probably a little overvalued here. We'll check out SYY, Cisco. They're interesting. I see their trucks a lot. So here's Vici Properties. Wow, they've taken a beating. This is your Vegas play. They literally 90% of their portfolio is all on the Vegas Strip. MGM Resorts, Caesars, the Luxor, the Wynn, The Las Vegas Spheres. Anyone heard of the Las Vegas Sphere Entertainment? They do triple net leases and own the land under all of those properties. So yeah, like those gaming facilities, we'll call them, because I don't want to get in trouble here. Yeah, here's one of Caesar's Palace, the Venetian or MGM. All these places is pretty cool. Hard Rock Cafe. So golf clubs. Where's the Luxor? They have a used to have a. These are all the pictures here. Okay, well, there used to be a lot more pictures, but and we could look at the. Actually, I've made a lot of YouTube videos about VG properties before. Let me see if I can go find one of my old videos about them, or maybe there's too many. Hey, look at this one. Here's one I made about realty income. Uh, anyway, oh, dude, this is an old video I made. Oh my goodness, top 3 REITs. I was going over Vici. Oh my goodness. Hey, if you want to support me, the best way to support me, subscribe to the YouTube channel. It's called Nathan Roberts, also in the link tree in my bio. Yeah, the Luxor is that big pyramid. You're right. So pretty cool. That's a triple net lease. But the sad part is, if we go look at the actual Vegas is slowing down right now. I forgot to get to this point. I would not really own any of their tenant stocks. Like, think of Caesars right here. You know, Caesars is the one paying the lease to Vici Properties every month. Caesar stock, I wouldn't personally own them. They're the same price as they were in 2014. Look at Wynn Resorts, WYN, and this is just some of them. Wynn Resorts, same price as they were back in 2007. Yikes. What's the SPHR? Here's the Sphere Entertainment. Wow, look at the Sphere Entertainment. They basically just got their first ever revenue. Wow, they've had a massive little rally there. Not too shabby. Okay. Oh yeah, WINN. Yeah. You're right, Clem. Oh, there's a stock I wanted to look. Oh yeah, Okta. Let me get to Okta here. So this is a software company. You know, every time I log into my college software, the big Okta logo in the bottom right. But the forward PE is an 86. So here's what I noticed. The current PE is a 78, but the forward PE is an 86, which means the net income is supposed to fall slightly. Did they have a one-time adjustment or something? I don't know. Okay. Oh, actually, that they just have low expectations. Notice they constantly beat on EPS by a wide margin every quarter. So that's probably it's probably the forward P is maybe like a 60 or something, but it might sadly be, it's probably fairly valued around this probably $85 level. It deserved to fall from its major price up there. And I know a lot of the software names are just being hurt by the AI thesis, but this one has a lot of net cash. They have $2.5 billion of cash, and that cash is earning them interest of 27 or 25 million of interest on their cash every quarter. That's actually crazy. Are they doing share buybacks? So, no. Oh, but look at this. So these are, I love how they're all next to each other. So the net issuing common stock, they didn't do any share buybacks or dividends, but they paid off 500 million of debt, which is great news. So yeah. So look at the asset to liability ratio. It went from 30% to 25, or quarter over quarter went from 29 to 25. So the assets go down with the liabilities. They deleverage. Great news. Cool. Put them on the watch list though. Any good cybersecurity stocks? Palo Alto, they're all overvalued. That's what sucks. Palo Alto Network's got to be my favorite. Second place would be like a CrowdStrike. There's like ticker symbol bug, I think. I think this one has a high expense ratio. The Global X Cybersecurity ETF. What is this on? I think like CyberArk, which I think is being acquired. Oh, Fortinet, dude. I love Fortinet. CrowdStrike, Palo Alto Networks. I think Palo Alto Networks is acquiring CyberArk. There's also ticker symbol hack. It's another kind of, if you don't know which individual cybersecurity name to buy, maybe just buy the ETF that owns a group of them. Cisco, dude, Cisco's a great cybersecurity play after their acquisition of Splunk, which I used to own as well. That's actually why I actually do like Cisco, and Cisco has a decent yield too. So let's see Cisco here. SYY. Cisco. So this is very cheap PE, a 15 forward PE. Basically, restaurants order food from Cisco to sell in their restaurants, like everything from ketchup to, and if you look at any restaurant right now, they are struggling hard, which might be why Cisco's just struggling. Like Wendy's, for example. We look at Wendy's stock. That's not too good. They're at like all-time low. We pull up like a Jack in the Box, ticker symbol Jack. They're also kind of pretty much at an all-time low. Starbucks is struggling. Donut, Krispy Kreme. Like these are all just examples of restaurants here. All their stock prices are doing terrible right now, which just eh, which explains why probably Cisco is also doing pretty bad. Let's go look at their growth metrics. So, oh yeah, so look at this. This is actually not good. Look at the revenue. It's low single digits. This doesn't really beat inflation. 3%, 2.5%, 1% revenue growth. But if we go to the net income is slightly down, -2, -13, -5, -2. So they're losing their pricing power. So they're losing their margins a slight bit. But the good news is they're still easily making easily 400 to 500 million of after-tax net income a quarter. So let's see how much the dividend cost. The dividend cost 259 million, so around a 50% payout ratio. And they're even doing a bit of share buybacks too. So let's see, the net income's down by 2.8, but the net income per share is actually flat because they bought back 3% of the shares. Wow. And you get a 3% dividend. That's actually a nice little combo. 3% dividends, 3% share buybacks they did. Oh yeah, let's get to Dell right here. What up, Ishwar? So Dell, I wish I bought this one over Super Microcomputer. Yes, Cisco supplies food, and the other Cisco is like the software cybersecurity one that bought Splunk. But here's Dell Technology. This one just sells a commodity, but they're like a value play. 18 PE. The forward PE is like a 15. So 15 forward PE, 1.45% dividend. But you are not going to believe the buybacks they're doing. You're not going to believe it when I show you in a second here. But if you go to their infrastructure solutions, that gapped up very nice, the record quarter. I mean, that's insane how it just like gapped up like that. But let me actually see what AI has to say. Let me see what I haven't looked at their earnings in a while. Oh, well, they went away. Is there any news down here? Nope. Okay. Well, that's all right. But check out this net income right here. They're easily doing over a billion, well, more like 1.3 billion of after-tax net income a quarter. What are they doing with 1.3 billion? Here's the buybacks I'm talking to you about. Yeah, so here's the dividend. The dividend cost 350 million. It used to cost 396 million. How did the dividend cost go down? Because the share buybacks. Whenever you buy back your own shares, you don't have to pay dividends to those shares anymore. So it's great news. So they're doing billions of buybacks a quarter, and here's what that does. Net income's up by 38, but the net income per share is up by 44. They bought back like 7% of the shares on top of the 1.5% dividend. Low margin business, commodity kind of, but they're interesting. I maybe wouldn't mind as a small size position there. Yo, someone said DX is the best. Is that Dynex Capital? This is actually not a REIT. This is actually a BDC, I believe. Let me actually verify. Oh, no, it's a mortgage REIT. So it's kind of a mix in between of both. But yeah, these are the kind of companies that have to, by law, pay out 90% of their taxable income in the form of a dividend by law. So these super high yields, 13% yields, are because they're not, they're kind of sustainable, but these never outperform in the long run. Like you can kind of just see the stock price here. I mean, it's not just Dynex Capital; it's all the mortgage REITs, all of them. I wonder if like Seven Hills. This is what I've looked at all the mortgage REITs out there. Seven Hills was one of my favorites, but dang, they're doing terrible. There's a lot. I would stay away from the mortgage REITs. Not good unless you just want to maximize your income. Yo, Narc692 said happy investing. Yo, you too, man. Happy Sunday too. Someone said, "Ooh, what website is this?" Yo, Arctic. Yeah, if you want to get this, actually a brokerage where you buy stocks on. If you want to get it, it's in the link tree in my bio. The very first link there. It's also an affiliate link too. So if you go and deposit $100, we'll both get like some free stocks. Help me out. But you can just type it into Google, just a brokerage called Moomoo. So let's check out Fortinet right here. This is another phenomenal cybersecurity play. Forward PE of a 35. So this is a subscription model play. If we go where the revenue comes from, 39% of the revenue is their cybersecurity subscription. And check out the growth. It literally just hits a new record every year, every quarter. That's what you want to see for a growth stock, and that's what I can kind of trust on this company. Product revenue also up 18% to a new record. Technical and other support. So yeah, if we go to their net income down here, they're printing net income, easily 500 to 400 mil in net income. It fell 12% year over year. That might be why they gap down. When you have a high multiple, any little miss on growth will collapse your stock. But this looks like a great name. I mean, I love 80% gross margins, 30% net margins, software, cybersecurity play. And I love cybersecurity specifically because of how like somewhat immune it is to the whole AI stuff, because hackers will utilize AI and get better at it. So, yay. No way, dude. Shout out to the homie Tommy1 on the YouTube stream. Dude, no freaking way. Thank you so much. Yo, Let's look at, yeah, he says opinion on CRH. Yo, CRH actually just got added into the S&P 500. So if we look at them after hours, the reason they gapped up on Friday after hours is because they just got added into the S&P 500. So there's just going to be so much passive flows that just go into this company. All the S&P 500 copy ETFs will all have to buy the stock as well. So even that aside, because that'll just be like short-term momentum for a while, those passive flows will capture the order book. But if we just judge them off their financials, which is what we really do, this is a good name. The forward PE is a 20. The current PE is a 23, so the net income's supposed to grow a nice chunk. But yeah, let me see what they do specifically. But they just got added into the S&P 500. Looks like they says sort of materials for real estate or something like that. The leading provider of building materials. Wow, they got 80,000 employees. We turn materials into things that matter. Okay, is there any examples? Global project, 72-hour tunneling through a mountain. Well, anyways, looks like some sort of building company. And the forward P of 20 looks very nice. You know, they did 1.5 bill in net income this quarter. That was after they paid 400 mil of taxes. So they made 1.5 bill in net income this quarter. And the cost of the dividend is only 250 million. And since the dividend's so little, they do massive share buybacks, 200 to 300 to 400 mil of share buybacks a quarter. CRH is really interesting. Actually, let me put them on the watch list. S&P inclusion should be nice for them. I also own ticker symbol FIX, and this is another company at the exact same time as them got added into the S&P 500. Comfort Systems is now in the S&P 500, so I can't wait to see what happens at 8 p.m. tonight. Yo, thanks again, Tommy, for the $4.99 super chat. He also said MTZ stock. Yo, let's check out Nasdaq right here. So again, sorry, I got to get to the member first here, and so yeah, then we'll look at Shopify, Netflix. Remember to get to Skyward Greed. I'm so sorry if I didn't get to that one. Maztec right here. So Maztec forward PE is at 37, current PE is at 52. So again, nice net income growth expected. No wonder this stock is at an all-time high because there's so much future net income growth expected. And notice they beat on expectations every quarter. That's the orange line. They beat on revenue every quarter. They beat on net income, which is EPS, and slightly on EBITDA. So yeah, the EPS is going to go from 13 cents to 32, which really is a nice year-over-year comp. Great net income year-over-year comps. Yeah, 60% growth, 100, like triple digit, quadruple digit that quarter. So they've just really fixed their margins. Yeah, the net margins used to like be so choppy, be zero, but now they're making consistent profits. So that's the great news. I can see why this one's doing so great. George Maz is the largest shareholder. Another building communications. I click on their website right here, maztech.com. I guess it does that not exist? Or anyway, maybe it's just glitched or something. But anyway, interesting. Super interesting. So Shopify, this is a phenomenal name. Shopify's in the Kathy Wood portfolio. If we go to her portfolio, you know, Kathy Wood, she kind of lost a lot of respect because her portfolios have all outperformed. You know, what's cool is you can see all her different ETF. She owns a bunch of ETFs like a ARKQ, the robotics one, and all these different ones. But anyway, her second largest holding behind Tesla, that's 10% of her portfolio, is now Shopify. I love Shopify. I used to have a Shopify store. And even if you pay for their highest level subscription, you still have to give Shopify 0.25% of every sale. So they basically collect a royalty. What's this app? Yeah, hey, Adam, this is actually a brokerage. If you want to get this app, it's in the link tree in my bio, that very first link there. But yeah, Shopify, they're super expensive, unfortunately, but they deserve a high multiple for sure. 120 forward PE. But if we go to this is why they deserve that. If we look at the annual revenue growth here, you can't make this up. This is why Shopify deserves high multiple. It just hits a new record every single year, every single quarter. So that growth is just phenomenal. And not just, top line, but bottom line. This is the FCF, which stands for free cash flow. A couple $100 million of free cash flow every quarter. And net income, they did a little one-time adjustment, and net income every quarter. These year-over-year comps are amazing. So honestly, that forward PE is definitely wrong. Well, maybe it's doing it off 42, 27. Really, it's 120. I mean, I love Shopify, and I'd love to own that company eventually. What's your best dividend stock you would recommend? Well, I don't know about Best one, I love having a group of like, well, it depends on what kind of dividend stock you want. Like a great dividend stock is like Google, but it doesn't have that high of a yield. If you actually look in the top left of this portfolio, this is actually called my dividend only portfolio, where every stock in here pays a dividend. So these are all my favorite dividend names: Google, McDonald's, Carlisle, United Rentals, Meta. They all pay a dividend. Pretty, but they're mostly like dividend growth names. But yeah, McDonald's is a great never sell. Even Microsoft, Google. Hey, thanks, Tommy. Appreciate it. How do you feel about those two long term? Yo, those look great long term, dude. But looking at both of their financials are amazing. CRH looks more high quality out of the two. I love their even, MTZ. Do you not feel like everything is slightly overpriced? Almost all new entries seem here. There are certain sectors that seem super overvalued, but when we just look at the Mag 7, we're not at super bubbly prices yet. That's why I think the S&P 500 can go higher. If you look at Microsoft, 29 forward PE, Google, 29 forward PE, Amazon, 29 forward PE. I think they all have like a 29. I think NVIDIA's is at a 29 as well, which is crazy. So like valuations are fair. Walmart's more expensive than all the Mag 7 ex Tesla. I mean, actually, Walmart's been on a tear. Look at that. Walmart's at an all-time high. Crazy. All right, yeah, let's get to Netflix right here. And then we got to get to MELI. What up? Check it out. We'll do NFLX right here. This one is buying Warner Bros. Discovery, which is HBO Max for $82 billion deal. So Stranger Things final season launches, Netflix to acquire. Netflix to assume $61 billion of debt. So I wonder if the government will allow that. I think they already will, but Netflix already has the number one market share, and they're acquiring basically another 15% market share. So that'll be interesting. But yeah, I love Netflix in this model. I mean, it'll be, I think, good if they acquire them. That'd be kind of cool to see all the Harry Potter stuff on Netflix and stuff. But yeah, they have right now, just Netflix themselves, 300 million premium subscribers, and they're making $11.69 on average per user per month, which is crazy. We go to the net income, they're printing $2.5 to $3 billion in net income a quarter. They had the password crackdown and it went very successful. Same with the free cash flow. The free cash flow is massive, $2 to $3 billion a quarter. So that really changes things up. It looks like the market doesn't like the acquisition because, usually the person acquiring the business, Netflix was in a bidding war with some other companies. And each time the price goes up, it's less accretive and it's maybe even decretive. I don't know. But if they go down to like $90, if like sub 100 probably seems like a good time I wouldn't buy them crazy yet, but I just maybe start the nibble. Yo, actually, so sorry. Let me get to Sky W, then we'll get to MELI. Oh yeah, Realty Income. That's a monthly paying REIT right there. So Sky West. I actually haven't heard of this name before. A $4 billion company, and they traded only 10 times net income. So Sky West Airlines and Sky West Charter. Well, that's actually seen some nice growth. I don't normally love the airlines, but Sky West, I don't know if this is exactly an airline. Well, they've actually outperformed, Delta Airlines, United Airlines. Let's see the net income. So this is actually what I love about this company. They're making consistent net income. If you look at all the other airlines, they make a bunch of money, then lose money. This is very consistent net income, and the growth is actually crazy. 30% net income growth, 59, 66, 450, and they're deleveraging the balance sheet. Their liabilities are going down. So yeah, I mean, looks like everything here is headed in what's the net margin? So they have just over double-digit net margin. Not too shabby. Engages in, it looks like Sky West. Huh. Interesting. All right. Normally in a recession, those don't do great. Yeah, what up, straight? Yeah, Shopify looks pretty cool. It might be a little overvalued right now, though. So Starwood, yeah, this is another mortgage REIT. You buy this to maximize your dividend income. This is one of the companies that are like REITs. They have to pay out 90% of their taxable income in the form of a dividend by law. I think they mainly do like lending, but yeah, they have a 10% dividend because of that. Their dividend stays the same every year. And you can kind of just see the stock price. It doesn't really outperform. Actually, this stock is the sm price that it was back in 2010. So you're buying that to maximize your income. That's kind of the same thing for like a Realty Income. Sustainable yield, but Realty Income is still down bad from 2019. But I love Realty Income. This is your triple net lease REIT. and they pay monthly a 5.5% yield. I love. Well, some of their top tenants are not great, but or like recession prone. Oh, wait, VYM ETF, and then we'll do PayPal. Hey, PayPal, yeah. Oh, Caterpillar, that one's phenomenal. I would not trim or sell a single share of Caterpillar. Remind me to get to them in a minute. I got a few we got to go here first, but this is the Vanguard High Dividend Yield ETF, and even though it's called a high yield, this the ETF has done quite well. Look at that. I don't think the S&P 500 closed at an all-time high, and this one literally hit an all-time high on Friday. Let's see what it owns. So probably Johnson & Johnson, I guess. Yeah. Broadcom is the largest holding, then JP Morgan, ExxonMobil, J&J, Walmart, AbbVie. I can't believe these are all like my favorite like high yielding names, like JP Morgan, J&J, Exxon, Walmart, AbbVie. Dude, AbbVie's a gem. So I actually really like that ETF, man. And you get a higher yield than the S&P 500. You know, actually, who just started paying a dividend is PayPal. Now, this one hasn't done too well. Actually, it's done terrible. PayPal is the same price that it was back in 2017. So it's been flat for almost a decade. But I love that they're doing a lot of share buybacks right now, and they just started paying a dividend. Let's see if there's any news here. PayPal CFO signals slower growth in branded checkout, but maintains guidance. So their buy now, pay later debit cards and processing business are maintaining growth. Okay, well, let's go look at their numbers. One thing that the top line growth on PayPal has been slow, I think. Let's see. So yeah, 6%, 8%, 8%. So the sales growth is starting to slow down, but they still print net income. That might be why they traded 12 and a half times PE, in that part. It actually traded a much higher PE, but they've bought back so much of their stock that it makes the PE look lower. What I'm trying to say is it might be fair. Like, it's not actually probably crazy undervalued here. It's not probably undervalued. I don't know. But here's the cool part. They're easily making $1.2 billion net income a quarter. And what are they doing with that $1.2 billion net income a quarter? Well, around $100 million of that now goes to a dividend. Like $111 million of that will go to a dividend. But they're plowing it in share buybacks. If you look at the top here, there's been a $1.5 billion of their net income a quarter on buybacks. And here's what that does for you as a shareholder. This is what's crazy. The net income grew by 23, but the net income per share grew by 31. That's because the share part of the ratio went down so much in the share buybacks. Again, the EPS growth rate and the net income growth rate should always be the exact same. But so they just started paying a dividend too. That's really cool. Just around a 10% payout ratio on the dividend. But PayPal, I give them so much fees and stuff. It's it's probably worth a little. It's probably worth a small hold. Like, I wouldn't have it as a major size position. I hope that they haven't kept up with the S&P 500. I mean, same price as 2017. We want to see growth. Like, I almost, how they did $7 billion on share buybacks this year? I almost wish they bought a company for $7 billion and add that to growth. But they are innovating with their buy now, pay later services and stuff. So you buy the shares and they pay monthly. Yeah, Ben, that's what realty income is. But what you see with these higher yielding stocks is there's a hidden opportunity cost that people don't really like to really talk about with these covered call ETFs, these super high yielding stocks. You get a 5.5% dividend yield on this stock. So you get 5.5% of your money back in a dividend, but also if you're hoping, you don't get any stock price appreciation on top of that. Realty income is the same price that it was in 2016. So you've severely underperformed the S&P 500. So kind of like a rule of thumb, the higher the yield, you're almost certainly going to or the higher the yield of the stock, you're almost certainly going to underperform the S&P 500. And I've looked at there's some stocks that have a perfect balance, like an AbbVie, a McDonald's, but BAC is great too. Someone said Home Depot just filed Chapter 11. No, Home Depot's doing great right now. But actually, Home Depot was blaming their comps, the year-over-year comps, from lack of storms. I was listening into that because I own Carlisle Group, and he was kind of right because like a year ago there was all the Orlando and the fires and the North Carolina hurricane and stuff. We really haven't had any. That's great news though. But Home Depot is blaming that on the earnings. But Six Flags, what weird. We're looking at the Six Flags earnings. Six Flags is saying, "Oh, there's too many storms. That's why people aren't coming." Dude, Six Flags is just going bankrupt. I think that's why they're just mad. That's ticker symbol FUN. Let's check out Six Flags Entertainment. Yikes! Look at that stock. Oh no, lower than the pandemic low. Dang, that's nearly an all-time low on Six Flags. Same, lower than they were in 1997. You bought the stock in 1997 at $20. Well, it's 15 now. Okay. Yeah. Hey, what up, Luffy? PayPal got no moat or growth. That's actually a good point. I guess Apple Pay. Actually, Apple Pay had to allow PayPal integration or to allow, but yeah. That's, the moat is kind of like the protection of the business. Like, how hard is it to copy? Like the railroads, for example. Like, we're never going to get any new railroads, so they have UNP Union Pacific at a high moat, or that's the Morningstar research right here. Let's see. They have like the moat, economic moat. They have a wide moat here. Let's actually go see what they have about PayPal's moat. PYPL. Let's see if they have PayPal has a moat. So it's that they have a narrow moat, is what they're saying. Let's see. Here's another cool thing we kind of get here on this app. You can see what the bulls say and what are the bears saying. So here's what the bulls are saying. There's still plenty of runway for growth in electric payments, scalable nature of the business. PayPal's long-running experience in online payments is a unique asset. More value as e-commerce becomes a bigger piece of the pie. Yeah, I think they have like a partnership with Luffy, I did used to own Realty Income. I did sell them because of the opportunity cost. For my age, I really should be in the S&P 500 over Realty Income. And so I kind of converted that. But opportunities to monetize Venmo could be limited, they're saying. Alipay and WeChat provide examples of how governments could favor local players, and this could shut PayPal out of a number of emerging markets. Anyway, there's always bulls and bear cases. So yeah, let's see here. Is bull still a good stock? Hey, a potato stock. What up, dude? I think so. I do like Webull stock. I do own them. Someone said Alaska Airlines. Yeah, I just don't love the airlines. They get smoked in a recession. This is the same price they were in 2014. But are people traveling to Alaska? Let's see. Oh, Alaska and Hawaii Airlines. Those are kind of two unique kind of airports there that I guess you can own. But yeah, just these aren't like numbers you can really trust. I mean, the numbers are just so choppy here, sadly. I don't know though. I just don't love the airlines. There's funds out there that literally go they buy the S&P 500 but remove the airlines and the cruise lines and stuff. Like, they just are so recession prone. Yeah, hey, Waste Management. I do want to get in this name, or back in this name. Waste Management is a phenomenal, talk about one of the safest stocks. That's like AI proof. People are always going to throw away their trash, and Americans are always wasteful. But anyway, yeah, Waste Management. It just keeps on chugging along. They pay $600-700 million net income a quarter. Bill Gates love it. Bill Gates owns 7% of all the shares, or the Bill and Melinda Gates Foundation. So Waste Management's phenomenal. Hey, Agent said MU stock. Let's look at Micron right here. Home Depot did file Chapter 11. Oh, I didn't realize that. Really, Clem? That's actually interesting there. Is that some restructuring? It's interesting. So I know they're not defaulting on debt payments because they make good. But that thanks for clarifying that. I didn't know that. Actually, let me see if that's in the AI news down here. Home Depot to provide 2026 outlook. Well, declared Chapter 11 reported by Yahoo News 2 days ago. Something like that. I don't know. Okay. MU stock. This is Micron, a phenomenal name. If I was a shareholder, I would not trim. Hey, what up, Fort? Good to see you, man. I would not be selling or trimming out of this name, even after all the stock price appreciation. I think this is the kind of stock that's just going to continue to climb higher. Because of this, the current PE is a 31, which is still fair for the growth, for the massive growth that they have. I'll show you in a minute here. But the current PE, they trade at 31 times net income, but they traded only 15 times next year's net income. And that's real. Check out the EPS growth rate. It's literally going to go from $1.40 to $3.70. And that's if they just meet on expectations. They always slightly beat on EPS every quarter. So that 15 forward PE is really real. check out the comps here. The sales are up 46% after it grew 93, and the net income is 3.2 billion. 3.2 billion net income, that's after they paid 400 mil of taxes. So that was real. They netted 3.2 bill, and they just expect that to just continue. That's insane. They're supposed to be even higher record net income quarter the next quarter and after that. So they're supposed to have like 3.8 bill next quarter, and there's so much future growth. Micron's a beast. Wow. Wow. Hoping I'm not late. Have you covered Netflix? Hey, we did already cover Netflix a few times, but if you wait like 10 minutes or something, we'll cover Netflix again. Um, Chime in North America Builder Supply filed Chapter 11 according to the street, a rival to Lowe's and Home Depot. Oh, hey, what up, 6-star Chime, huh? Um, yeah, Realty, you could get in low now for your dividend portfolio. I'm just not, for my age, I don't want to own Realty Income. I used to own Realty Income, but it just will not, for my age, it would be not smart for me to own them. It will not keep up with the S&P 500, and it historically has never kept up even closely. So, just not for me in my age right now. And I just don't need the income. All the income I'd have, I just reinvested anyway. So sometimes let me pull up Realty Income. Here's Realty Income versus the S&P 500 here. So, actually, Realty Income is in the S&P 500. It's a dividend aristocrat, which means it's been raising their dividend and never had to cut it once for over 25 years. They have a 98% occupancy rate, triple net leases. They're one of they have a super sustainable dividend yield. Realty Income does. Oh, Joel said AutoZone. I'm looking to buy this stock for real. If they go a little lower, this was a golden price. I mean, the reason why the stock is 3,800 per share is because they don't do reverse splits and they just do massive share buybacks. But if you look at the PE, it's a 26. They literally trade at 26 times PE. And if you look at their stock price, it's been monstrous. No other, it just doesn't go down. It literally doesn't go down. They actually kind of benefit from a recession because even in a recession, people will spend more fixing their own cars and getting a new car. And even if your tire, AC, whatever goes out, you got to get that fixed even in a recession. So normally a company with this kind of slow single-digit growth wouldn't have that kind of stock price appreciation, but it's actually because of the share buybacks that they do. They have a rule where they literally return over 50% of all the net income and profits they make to the shareholder in share buybacks, not by doing any dividends. If they did a dividend, they'd have a 4% dividend yield, but they choose to not do a dividend and instead do share buybacks, which just forces the stock to go up, which is great. And look at this. 400 mil buybacks, 200 mil, 300 mil, 500 mil, 600 mil, billions a year. And all the buybacks that they did until, look at this, since 2022, they did billions a quarter are also accretive to right now share price because they bought back, here's the thing. They bought back 5% of the company down here, then another 5% at here, then another 5% here, and it'll just never go back to those prices. So that's why I specifically always look for companies that do share buybacks. Almost all my companies do share buybacks. Every single stock in here does massive share buybacks, every single one of these. And they do dividends. So I should really call this my dividend and share buyback portfolio. But yeah, I'm a huge fan of AutoZone. 25 PE, not too shabby, but single digit growth. Yeah, hey, Fork, we already looked at snow a few times. By the way, if you missed anything, you can also replay it on the YouTube stream. We're also streaming on YouTube. It's on the YouTube channel called Nathan Roberts, also in the link tree in my bio. But if you give me a while or a minute here, we'll also look at them a little later. Let's look at CoreWeave right here. So CoreWeave, this one is in the NVIDIA portfolio. I am not super bullish on this one on the long term, but check this out right here. This is CoreWeave right here. There's nothing really so proprietary. They basically just own a bunch of data centers and GPUs. But these GPUs are in such demand right now from cloud computing, Microsoft Cloud, and they have an insane backlog. You won't believe this actually. So their contracted backlog doubled quarter over quarter to 55 billion, and that was fueled by large contracts, including a $14 billion deal with Meta and a $6.5 billion expansion deal with OpenAI, which is great news. But they actually lowered their guidance by 200 million because of delays in third-party data center deployments and increasing scaling costs. So they did lower their guidance, and that's kind of why they've been struggling. But this one is kind of like a high beta NVIDIA. There is a bit of a bubbly. They have super nice growth. Oh, dude, hold on here. They have super nice top line growth. The revenue went from 580 mil to 1.36 billion. But check out what it's going to be in 2 quarters. It's going to be 1.5 bill and then 2.3 billion just from this contracted backlog they're going to fulfill. But they're not profitable anytime soon. Hold on, guys. My thing just disconnected, and it probably. Hey, if it lags for you, that was my fault. Okay, I just fixed it. Okay, yeah, Corey, they do lose a lot of net income every quarter, but they're like an AI momentum beneficiary. I have to reconnect my phone here. Okay, but in the long, I think this will do probably good for like 2 years or so. But I don't know how I feel about this one in the long run because there is some like short cases around like this one and Nebius because Nvidia is a huge shareholder of this company. This is the Nvidia portfolio. They own CoreWeave, APLD, Nebius. Huge short case about Nebius too because Nvidia is taking stakes in these companies and giving them money. And what are they doing with that money? It's literally spending all of it back on Nvidia chips. So there's like this circular thing right here, but they're basically buying these Nvidia chips at a super high crazy premium. They're paying the 70% Nvidia tax for these chips, and in 15 years from now, the tens of billions they're spending on chips will literally be worth absolutely zero. So this is like depreciation thesis on these. So I don't know. There's nothing to blow me away there except the cloud deals and the top line growth. Not profitable yet. But there's nothing proprietary, just a company that owns a bunch of GPUs and data centers. And but they're so in demand because Microsoft doesn't want that liability. Meta doesn't want that liability, so they lease it from CoreWeave and stuff. And that's why Nvidia's taking a stake on them. Nvidia needs CoreWeave to do good. Notice they're all specifically these type of companies. Okay. Hood, yo. Robinhood is a beast of a company. Hey, you what up, Forex Sniper? Just came across your channel. I've always felt like a stock trader at heart. Yeah. Hey, I never got into Forex because isn't it just like the trading of different currencies? Like I love buying stocks, like real living, breathing companies that can do share buybacks and pay out dividends. And it's like, I love stocks. And just diamond handing them because if you just diamond hand stocks, you can get similar returns or better returns than the Forex traders and the crypto people and the option people, literally just buying and holding great quality names. Like it's so boring, but it works if you just buy high quality names and then you don't trim them. You just buy them off for the long run. But I'll of course have a diversified portfolio and you can't always get it right. Like I also have a bunch of losers. Yeah. Maybe O'Reilly Auto Parts. O'Reilly Auto Parts is like the same. It looks very similar to AutoZone. They do the same thing. I also love that one. Hey, what up, Narc? Can you tell us your background? Yeah, hey, don't listen to me. I'm not an expert. I sell nothing. I'm just a college student. I stream daily if you want to hit the follow button. And I sell nothing. I have no course, book, WhatsApp. Yeah, someone said earlier, did you just follow me, message me? That was not me. So please watch out for people impersonating me. I'll never follow you, DM you, and I sell absolutely nothing. So let's check out Hood right here. Best way to support me, though, if you do want to support me, the only way to support me and best way to that mean the most to me is just subscribe to my YouTube channel. I'm trying to build up my viewers and my streams over there because I don't get many views on stuff on YouTube compared to TikTok. But okay, let's check out Robinhood right here. This is literally this brokerage right here, publicly traded. And Robinhood is doing so well because they just added in this prediction market stuff into the app where you can, this is so dumb. You can get, it's the prediction market stuff, you can get better stuff. But anyway, that's what's making them a juice of a commission because whenever you buy and sell a stock on a brokerage, they make like a fraction of a penny. But whenever you do the prediction market stuff and whenever you go do the crypto market stuff, that's where they make a bulk of a commission, a really high margin commission. And that's why they're doing so well right now. The day Robinhood announced they had over $6 billion of their contracts traded, the stock rallied up like 10%. It was crazy. And they have the Robinhood Gold subscription, which I do pay for. But I also have a Roth IRA with Robinhood. Hey, I use their platform. I'm probably giving them a lot of fees and stuff. But yeah, that's also what Weeble's doing. Weeble's copying their successful business model. Their PE is a 55. So Robinhood certainly deserves a high multiple. You won't believe this. This is why Robinhood deserves all the hype around them. If we go to the revenue increased exactly 100% year over year. The stock doubled. So the sales are 1.27 billion. Remember this, the revenue was 1.27 billion. Out of that, they netted in net income 556 million. Dude, that's after they paid 80 or 90 million of taxes. That is insane. So that means their net margin is a 44. Incredible. So everything here is headed in the right direction, beating on every expectation every quarter, beating on revenue, beating on EPS, beating on EBITDA. So net cumulative funded accounts read a record. So I'm just so bullish on Robinhood and on Webull. I own all these apps. I own Robinhood app stock. I also own Webull stock, and I own Moomoo stock. I own all their stocks publicly traded because they're all great. And again, don't listen to me on bias. But here's my Webull position. It's in my Roth IRA right here. I got 50 shares of Webull. Oh, and then my Robinhood position. Yo, I regret every share I've ever sold a Robinhood. We're up 9x on them. I own 5 shares right now. It made sense at the time. Look at this. I was buying shares at $9, $10, $11, and then I sold 50 of them, the bulk of my position, for a 3x. And boy, was that dumb of me, because now they're up way more. So sometimes your biggest regrets will be selling out of your best positions. And oh yeah, here's my open profit and loss. We're up 19% all time in here. Not too shabby. Definitely underperformed. Hello, new sub on YouTube. Hey, Go G Star. Dude, thanks so much for subscribing. I appreciate that. Yeah, I'm majoring in finance right now. Yeah, prediction market is basically the same as poly market. Yep, exactly right. I have a dope way of looking at it. I like to say trade the money supply. Oh, that's interesting there. Hey, you're the sniper. Okay. Do you hold any crypto or stocks only? Yeah, I actually do not own any crypto whatsoever, but I own the picks and shovels of crypto. This is my exposure to crypto. I own Robinhood, where every time someone does a crypto transaction, they make a justification. Actually, here's the funny thing. You see, when I sold 50 shares of Robinhood at $36, that was the day Bitcoin hit $100,000 that day. And Robinhood hit an all-time high that day, because Robinhood used to follow literally so close to what Bitcoin does, because all of Robinhood's net income at the time was from crypto transaction fees, and they would just copy Bitcoin. And I sold this stock when Bitcoin hit 100K, but the stock has just continued to climb higher because of their prediction market and Robinhood Gold stuff. I didn't think, and now Bitcoin's way off 100K, but Robinhood has just continued to climb higher. Insane. Okay, let's see here. Okay. Thoughts on FIX? Well, hey, actually, I'll be so quick about this one. This stock just got added into the S&P 500, so I can't wait. By the way, we're going to be streaming at 8 p.m. tonight, or in exactly 6 hours from now, if you want to hit the follow button. And we're going to see how this stock opens. This stock just got added into the S&P 500. This is my favorite stock of all time. It's tough to buy it here, but it's not crazy overvalued. The forward PE is a 33. That's why I'm not trimming or selling a single share of this stock ever. That's actually part of the reason we've done so good in this portfolio. If you look in the top left, this is called our buy and never sell portfolio, because once you buy a stock in here, I never sell it. The reason we're up 82% or 87% year to date is because we didn't trim or sell anything before today. Like Coca-Cola Consolidated also hit an all-time high on Friday. The boring Coca-Cola bottler is crushing the S&P 500. But yeah, Comfort Systems, I'll be quick about this one. This is an MEP play, mechanical, electrical, plumbing play, mainly electrical and mechanical and electrical work from HVAC systems, and checked out their electrical segment. Like in the coming years, HVAC workers, MEP workers are going to be in such demand from the whole AI boom, where they are right now. Like there's a shortage of workers, of skilled workers in the industry. And so there's so much pricing power for it, from what has always been historically a commodity, But check this out. The electrical segment is up 72% year over year to an insane new record. Well, just check this out right here. If we go to the revenue, the sales, the lifeblood of the company, the revenue's up 35, but the net income is up by 99. What does that mean in English? Margin expansion. The net margin grew 50% year over year to a record. So they did 290 million net income. This company also pays a dividend. The dividend only cost 17 million, and they made 290 million just this quarter. So they have so much room to raise the dividend. They're doing massive share buybacks every quarter, and they're acquiring companies. They're known as a serial acquirer, because in HVAC, it's such a highly fragmented industry. And check out how they're just beating on expectations massively every quarter. Beat on revenue, beat on EB. They expected 620, they did 820. I mean, I wonder what it's going to be next quarter. I mean, maybe another $8 EPS quarter. That would make the forward PE even lower, like a 28 forward PE. Like that's why, if you look at the multiples and you don't trim stocks that do good, because especially they'll just continue to do good. Oh, yeah, if you want to, someone said what app is this? Yeah, hey, thanks for that. If you want to get this app, it's in the link tree in my bio. It's actually a brokerage where you buy stocks on. Very first link in the link tree in my bio. My favorite one. Very nice brokerage. GPC, let's check out this one. Hey, good to see you, Michael. Sorry, when you came in here yesterday, I ended the stream right away. That was my bad. So here's Genuine Parts, an $18 billion company. The current PE is a 22, but the forward PE is a 16. So they're supposed to grow their net income by another 30%. But the stock has not done too good on the daily. Let's go see if we can figure out what happened there. Oh, so yeah, they're in the automotive industry, and there's kind of just, that's not too massive of growers, single digit growth here. And they're also in the industrial segment. I wonder how that's growing. Ooh, so not as well. It's also 4%, but then some negative. So it's probably, that might be why the stock hasn't done amazing. So like single digit growth, 4.83132% sales growth. And the net income is actually negative every quarter. So their margins are actually going down. Like look at the net margin every quarter. There's like a year over year decline. So that's not great, but that also is probably why they're at like a 15 forward PE. And they did look at that every quarter. That's the EPS expectations. They miss on EPS every quarter. So that forward PE uses, these numbers. So, but they beat on, so that's weird. They beat on revenue, but they miss on net income. So that means they're just losing margins. I don't know. I'd be careful with that one. Do they have a dividend? They do, a 3.2% dividend yield as well. Wait for a dip for the 123. That could be interesting. Make close to 25K this year yet. I'm still losing. I wanted to start a channel. Hey, nice. Trade commodities. I'm just not good at trading and technical analysis and stuff. I just buy and hold great stocks for the long run, and I get some great returns. Let's check out Meta. What up, Rob? The goal isn't to get rich quick with stocks. You just aim for 10% returns a year with your growth stock. That'll double your money faster than 7 years. That beats the market, but the goal is to turn $100 into 110, then 110 into 125. It snowballs, 125 to 155, and the snowball effect. Snowball, compound interest, that's time on your side. Time in the market beats timing the market. So here's Meta Platforms. This is a great Mag 7 stock to just dime in hand and never sell. The forward PE is at 22. That's why valuations are nuts. According to my numbers, this is $1,000 stock, like pretty easily. It might take a few years, but you literally half the world is on one of their apps a day. They have 3.54 billion daily active users, which is just nuts. And here's one of the reasons they gapped down so massively on earnings. If we go to the net income, it says it fell 82% year over year to only 2.7 billion. So again, net income and EPS are the exact same thing. So the EPS fell 82%, just like the net income fell 82%. And this was a one-time adjustment, because there was a one-time $16 billion tax charge from the beautiful bill. So if we go to the operating profit, which doesn't include, this is why you always got to blend the net income and the operating profit, because there's the one-time adjustment. So it actually was a record Q3 profits, a record revenue, over $50 billion for the first time ever in one quarter. Another thing investors are questioning for Meta is how much they're spending on AI. Look at this, literally 20 to 25 billion of their net income a quarter they're spending on new investments. This is their cash from investing activities. If this number's negative, that means they're buying an asset, buying chips, buying they bought half of Scale AI for $15 billion, you want this to be negative. You certainly don't want this to be positive, as if like they're selling out of their own assets. But yeah, they can easily afford to do these investments, but it's currently over like 100% of their net income. And they have a net debt position for the first time ever with their new Prometheus data center bond. So, but Meta, one of the reasons they gapped up so much is because Meta actually, great news. This is what I've been saying. As long as they do some little announcement to cut the AI spending, Meta to cut the metaverse budget by up to 30%. That was so. The metaverse was over. They're too early for the metaverse. It's all about augmented reality now. Like the Meta Ray-Ban glasses are so cool. I mean, we're still not perfect on technology, but the Meta Ray-Ban glasses, I think that's more the future than like the Meta. I don't know. Okay. I like Meta. Instagram, Facebook, they just introduced ads to WhatsApp. They own Threads. Threads has the same amount of daily active users as X now, which is just crazy. So any recommendations for defense stocks? GE Aerospace, Raytheon, RTX, they own Collins Aerospace. Those are some nice Raytheon's done amazing. Wow. One morning a bull and bear appeared on his side. The bull said, prices rise. Yep. So Brian said Verizon. So this is another one you buy to maximize your income. Do you like the Mag 7 ETF? Yo, Austin, isn't that like MAGS? It's like, I don't like the Mag 7 ETF because I'd rather pick and choose the Mag 7 myself. I don't want to own Tesla. But yeah, let's go to Verizon real quick. We'll check out that ETF after this. So here's Verizon. They're the same prices they were back in 1997. You're buying, oh my gosh, I got to go in 1 minute. I didn't even realize the time. Actually, But Verizon, you're buying this to maximize your dividend income. They're the same price as they were in 1997. And if we go to the dividend, they have a 6.5% dividend. The dividend is safe, but you're buying this for your income and not expecting to outperform, the tech-heavy S&P. But the dividend does appear to be safe. I know they do have a bit of debt, but maybe you can check out one more stock right here. Have you gone over Sprouts Farmers Market? No, let's actually go over that one real quick. So Sprouts Farmers Market, this is one I love. I actually am down bad on them. If we head over here to our Weibo portfolio, we are down 35%. We did buy a little fractional share, more of them at $84 a share. So anyway, Sprouts Farmers Market, dog cheap valuation. I mean, they're trading at 16 times PE. So trading at 16 times PE, this is like a healthy grocery store. They sell like healthy items at Sprouts Farmers Market, more so than like a Kroger or Walmart. They're like healthy focused. And that's for these grocery stores, you focus on their net margins, and their net margin expansion is the reason I love them. Incredible margin growth here and net income growth. They're easily doing over 100 million of after-tax net income, well more than that. And they don't pay a dividend. All the other grocery stores like Kroger, Costco, Walmart all pay a dividend. This one doesn't pay a dividend. And what do they do instead of paying a dividend? Y'all aren't going to believe this. They do massive share buybacks. And I'll show you the total common shares outstanding. You won't believe this. So look at the bottom left. There's currently 97.45 million shares. This exact same time last year, there were 100 million shares. So already you own more of the company. So there was 100 million shares. Then the year before there was 105, and then 109, and then 100. So literally just since, this isn't even like since pre-COVID, just since 2021 right here, there were 118 million shares, 118 million. Now there's only 97 million just since 2021. Anyway, that's Sprouts Farmers Market. I do own them. Might be biased, but I hope you guys have a great rest of your day. We'll most likely be live at 8 p.m. tonight Eastern time, which is in exactly 6 hours from now if you want to hit the follow button. So yeah, I hope you guys have a great rest of your day. Let me kind of end this with a quick portfolio update here. And yeah, if you want to hit the follow button, we stream every single day, sometimes twice a day, and I sell nothing. I literally nothing at all. I have no course book, WhatsApp, Telegram. I'll never ever follow you or DM you, nothing like that. But if you do want to support me, best way to support me is just subscribe to the YouTube channel. It's called Nathan Robert. It's also in the link tree in my bio. I don't get many viewers on there compared to TikTok. But yeah, you can like rewind the stream. The very beginning of the stream, we always do a portfolio update. And but yeah, here's our Robinhood account. This is known as our dividend-only portfolio. We're up 16% year to date. Every stock in here pays a dividend, and all these are all also in the S&P 500. The only stock we're down on is Carlisle Group down there. It's that roofing company. We also have a Roth IRA. Roth IRA is just a tax-free retirement account. So it's so OP that the government only lets you deposit $7,000 a year. And these are the few stocks. I love keeping it simple. Since I have so many portfolios, but I only own like a few amount of stocks in each portfolio. I always recommend the S&P 500. Have the S&P 500 as the backbone of your portfolio. You can't beat it. Most retail investors and hedge funds cannot beat the S&P 500's 8 to 10% CAGR. So if you can't beat it, you at least need to own it as a small chunk of your portfolio or have it as the backbone, and then play around with your own individual strategy. And yeah, so if you notice like your portfolio isn't doing as well as the S&P 500 year to date, consider owning the S&P 500 at least somewhat, so you won't feel like you missed out. But anyway, see you guys very soon. Oh yeah, here's our Moomoo portfolio. This is where we buy and never sell stock in here. Can't wait to see what happens because Comfort Systems just got added into the S&P 500. Pretty crazy. But thank you all. Hit the follow button if you're new. And thank you to everyone on the YouTube stream. Y'all are the best. Thank you so much to Brian, all the members here, Brian, Looney, and Johnny, Michael, and Narc. Thank you for everyone who is here. Forex Sniper, Goju for subscribing. If you're still here and haven't hit the like button already, please hit the like button. It does help me out. But see you soon. We'll be live